Okay, we are now live. We'll give it a minute while people join, and then we will go ahead and get started shortly. All right, I see I'm filling in now.
I'll wait till it gets to about 55 and then I'll kick it off, Bud. You got a problem with that?
No, go ahead. You're going to introduce people too, right? To give their bio.
Yep.
Sounds good. Thank you.
I don't want you to work too hard on a Friday.
Somebody has to. Thank God for Katie.
Exactly. We'll give it another minute or so. All right, maybe we topped out with the 50 and 9 of us as panelists, so that might bring us up to our 60 number. So I think we're going to be good to go and start it off here. I want to say thank you to everybody for joining us today. Glad you all took a little bit of your day and spent it with us. And we're looking forward to having a good topic, 3 good topics here with 4 good speakers. We're going to kick it off with banking and merchant relationships, then get into the reserve establishment management, including tax appeal management. And then finally, there's going to be a 2-hour discussion on redevelopment programs and financing options. A little bit of housekeeping. We are going to pop up questions every half hour or so. We're not grading anybody on anything, so we don't want you to feel like you're being quizzed. We just want to make sure that you are still with us and you're going to get all the credit you possibly can. So when those questions do come up, please answer them as quickly as possible so we can continue moving on with the topics. Another thing, if you have questions, there's a Q&A box down at the bottom of the screen. There's also a chat box. Either way, I'll be monitoring that throughout the presentations, and I will go in and try to find a good soft spot where somebody's doing a presentation and they slow down a little bit, and I'll kick that question in. We'll get all the questions answered. We do like a lot of questions. You know, this is a virtual roundtable. You know, we get the credits and we get the hours and the length of this program because everybody gets involved. So please, if you have questions, go ahead and ask. We'll get those questions answered for you. And the whole idea is we're all learning with each other, right? So maybe there's a situation in your town that you've never seen before, but somebody else on here might have experience with, and they can go ahead and help us with some answers. So please ask away, encouraging you to do that. Before we get to the weekend, you know, I want to wish all the dads out there an early happy Father's Day. We know that moms do a lot of the work, but maybe you got, for the 5% of the work that we do, maybe we can put our feet up on Sunday, relax, and just enjoy the weekend. So happy Father's Day to everybody. First topic that we're going to speak on today, we're going to have Joe Lupino. Joe is a licensed CPA, CMFO, CCFO. He retired from the County of Bergen in 2021 after 28 years of service. He was a CFO treasurer from 2013 to 2021. And prior to 2013, Mr. Lupino was assistant treasurer for the county. At the county, he managed a $750 million operating budget and a $1 billion capital program. He currently is the vice president of government banking for Kearney Bank and a full-time CFO at the borough of Northvale in Bergen County. He's also an instructor for the Rutgers CMFO program. Teaches municipal budgeting, annual financial statements, county fiscal operations, and recently the CMFO review class. He's also a lecturer for IPD seminars and professional government educators. With that, I'm going to turn it over to Joe for the banking and merchant relationships. Joe, take it away.
Good morning, everybody. I'm going to share the screen. Just a clarification, I'm part-time in Northvale, not full-time, just as a point of information. So what I'm going to talk about, cash flow management, which is important, especially in terms of banking. and investing. As we know, we're in a high interest rate environment. So having a handle on your cash flow and making sure the timing and investing your excess cash into high yielding, it will be beneficial, obviously, to your budget, earning interest income. Again, we're, a year and a half ago, we were at 40 basis points. In a year and a half, we're, up to 400 basis points, or 4%. So big difference in interest income. So we want to take advantage of that. We're also going to talk about hot topics, mitigating fraud in treasury management. I changed the title. It used to be preventing fraud. I'm saying mitigating fraud, because it's such a hot topic. We always have to stay on top of that, and it's every day you've got a battle. I know at the bank we're always battling types of frauds, and so it's important that stay on top of your bank accounts, monitor your bank accounts daily. So we'll talk a little bit some strategies how your bank can help you with that. So with that, I'm going to share the screen. Let's see if this works out. And I'm going to click. Okay, am I good sharing?
Not yet, Joe.
Oh, okay, weird. Okay, one second, I see it. So I'm going to share the screen. How about now?
Looks good now.
Good. Okay,
Yep.
Let me do from the beginning. Okay. All right, good. Okay. So we went over that. This is my contact information. I'm always reachable. My cell is 201-679-6150. And there's my email, jlupino@carneybank.com. Okay. Again, we're going to talk about, as we said, cash flow management, types of fraud, internal, external, and red flags, cybersecurity fraud. And I'm not sure we'll get into waste and abuse of local government. Again, just John, you tell me when my time is up. Grab the hook. So feel free, give me a cue on that.
You got it.
Okay. Again, what's our objective? Our objective is to identify, establish controls to prevent fraud, waste, and abuse in local government, and to develop cash and fund balance management procedures. So that is our objectives for today. Why cash flow management? Well, again, cash flow management is an art. It's an art of successfully estimating the timing of your local government cash flows. You need to understand the experience and history. Again, you're looking at your historical spending. The good thing about cash flow management from our end, we know we pay our big expenses is our salaries, and that's usually either your 24 pays or 26 pays. So you could chart that out fairly easily. We know usually, depending on your municipality or county, when you pay your bills, if you're paying on a monthly basis or you're paying it twice a month, so you can chart out your bill payments. So you're, and again, identify your cash drivers. We know, we collect taxes 4 times a year. So we chart out, okay, February, May, August, and November. We know we're going to have some big inflows at those times. Municipalities, also there's an outflow. You've got to pay your county 4 times a year. So when that is, and your schools, you're doing that on a monthly basis. So again, this is not, and again, cash flow management, I don't think it's that, hard. I don't think we're, inventing the atom doing this cash flow management. And I do have a I do have a worksheet on this that I can share with participants if they want it down the road, which would be helpful. Again, why cash flow management? Again, you want to ensure the liquidity for disbursements, and you want to avoid issuance of short-term notes and TANs. So that's important. You don't want to incur any TANs if you don't have to. Again, we talked about improve your investment earnings. Again, your idle cash, you want to, this is not the time to keep cash in a in a zero or a low interest rate bank account. You could sweep, if you have a kind of an investment type of account, a cash, sweep it in. Again, you should be earning at least 4%. Hopefully you guys are earning at least 4% on your investments, or on your cash. So again, it's real money. Someone told me it's, now we're making real money. Everyone kind of is, everyone woke up, again, when there was 40 basis points, it really wasn't too much of an emphasis on interest income. So, but that can help you, obviously, bridge the gap on your budgets. We all, listen, we all got that 20% bill increase from health insurance. I think on average, the municipality pension went up at least 15%. And I'm sure pension's going to go up every year, at least 15%. So you got, again, if you're in a situation, the town that I do part-time, we just had bad timing. Our garbage contract came due. So of course, we went out to bid twice. We only got one bidder, and our garbage contract went up 30%. So because of inflation. So again, so it's important to kind of have all these, have all your cash invested to help pay for some of these increases. Again, cash flow management, getting back to the slide, it identifies short-term cash deficits, early warning for planning, warns of impeding budget problems. And it also assists in fraud detection, because actually if your cash is, again, if you have a projection and it's coming less, again, you look at your accounts and make sure that things are right. I had a situation fairly recently where it was a payroll account, one of our clients, and it's supposed to be a zero interest account, and it went negative, and I had to call up the client, and I says, hey, your account is negative, and he's like, well, that's weird. It's zero balance. And turned out there was some fraud, in that account. So we went into action, and, we were able to get the money back and so forth. So again, that is having that cash flow, knowing, geez, this doesn't make sense. You avoid a situation. Best practice, you want a cash flow forecast. You want also, obviously, your budget. You should be looking at your budget forecasts and a fund balance. I used to do that at the county every month. I knew where my fund balance was every month. I knew exactly where the number is. And as you know, we could always massage that number at the end of the year. You're always, again, you have a number that you're making. If you have a good year, obviously you can, before the end of the year, squirrel some money away into maybe some trusts. If you kind of know your number, what you want to come in at. So again, if you have the forecast and the planning, you can do stuff like that. If you kind of wait till the end of the year, that's not good planning. And this is from the GFOA. GFOA best practice. It's what's the components, consider historical information, projected financial. Now you want to compare your cash flow projection. The actual cash will assist with future. Again, you want to be conservative with your cash receipts, cash disbursements on your assumptions. and monitor your positions daily. And that's important also from a fraud standpoint. And I know we're all busy, and if we can have staff, get online. I know most banks, I know we have a very good online platform. You could actually do on our platform, you could do your daily bank recs if you want to, if you have time on your hands. But at least you look at it online and see if there's anything, suspicious and so forth. Very important. Constructing it, again, you need historical data from the general ledger, from the bank statements, currently at budget, obviously, capital project spending projections. You look at your, work with your engineers, DPW, figure out, when they need, if you're doing some projects, schedule out your projects. Debt, again, we'll have our debt payments. We have our amortization schedules already, so we know to plug that in. Pensions, the big payment is in April. So, April, I remember at the county and now at the municipality, April's always a tough month on cash flow once you make that big pension payment. So, be mindful of that. Investment schedules of maturities. Obviously, if you have CDs, know when they come due. And again, identify what your major revenues. We all know property taxes are probably our biggest number. Energy receipt tax, that's a big number also. Construction department fees on the municipalities, also sizable. Licensing fees, interest. Now interest income is, can be the way you look at it, interest income, you want to make that a big revenue source if you can. Grants, if you got sales of assets for some reason, if you have a big sale of an asset, so you know when that comes in. And obviously we talked about salary and payroll, pension, employee benefits, utility, county taxes, we know when they're paid, school taxes, debt service, operating, and if there's any non-recurring legal land acquisitions, know that, of course, plug that into your analysis. And simply, again, this is not, rocket science. Beginning cash balance, monthly receipts, monthly appropriation, and your ending cash balance. So nothing too hard about that. And I do have a template. Now I am going to, let's see if I could do this. I am going to share. Okay, let me see. Am I sharing this simplified forecasting model?
Yes.
Perfect. So I got this from the GFOA. So what I'm doing is let me go to the, hold on. Okay. Data. Okay. Let me bring it over here so I could see it. It's a little bit small, apologies for that. But what I'm doing is and again, I can share this, customizing it to Jersey. So obviously I have my property taxes, right? And I'm scheduling, right? Where's, again, obviously most of them are going to come on in February, May, okay, August, okay, November, surplus, okay, that's usually a journal entry. You do the journal entry in January. It's not really a cash entry, but the alcohol beverages, when are they coming in? You schedule those. Your energy receipt tax, right? They come in towards the end of the year, most of them. Any grants, fines in courts, usually that's on a monthly basis, right? And then reimburse. I put in reimbursements if you're, getting your Chapter 78 from your employees. You bring them over. That's what we do. What we do is we bring them over every payroll period. Actually, that's probably should be every payroll period. So I should probably change that to we're at 26 pays. And then we bring it into our current fund, and then I offset the health benefit appropriation line on that. Interest income, that should be a monthly. Okay. Fines also, construction fees. So this seems pretty good. So, there's my income and then my expenses, salary and wages, we obviously, we'll chart those out, benefits, contract, utilities, school taxes, monthly basis. So this again, this, I just threw these numbers in. These are not actual at this point, but I'm kind of customizing it. So it shows me, all right, I got a little bit of a deficit in January, but then February, I've got a plus because I'm collecting taxes. So, there's an opportunity in February, maybe where I, try to squirrel away some, maybe money into some higher yielding interest accounts, and then, March, where's my pen? March and April, you're going to have a deficit. We're showing a little bit of a deficit because we got the big pension payment on that. So you got to be mindful if you're investing in February, you're going to need some money. You're going to need funds in April to make your pension payments. So yeah, so I could definitely, and this has like a little bit of a chart, as you can see, kind of your inflows and outflows. So I thought this was a pretty good one. I'm still working on this and kind of, but this is kind of this is already made. This could be helpful for you folks. So let me stop sharing. And yeah, okay, now let me go back to the, okay. Am I good with the cash flow template, right?
Yes.
Okay. The other thing, and that it's important, is fund balance. Look at your fund balance. This was actually, we'll go over this one quick. This was actually, I put this, this actually was on the CFO exam. This was actually one of my, I did a seminar, and I think it was for IPD, and it ended up being on the CFO exam. I think 3 times in a row. So let's go back 1 second. So yeah, so this is again, just to be quick and dirty. So you have your adopted budget. Obviously, you have your realized revenues, excess and deficit. You have your excesses and the deficit. So real quick, so our miscellaneous excesses in this problem, we had an excess of 704. We had an excess of delinquent taxes of 77,000. Okay, and then in our tax collections, we had an excess of 96,000, so 878,000. Okay, let's go to here. And so this was the beginning balance was 922,000. And maybe I'll make this interactive, John. I'll just throw this out. Okay, so we know, hopefully everyone knows non-budget revenues, that's in addition to fund balance. Okay, and then our debt service, right? We budgeted $1 million. We actually spent 989,820. So we know that the difference will go right into our fund balance or operations. Our lapsing, right, goes into our fund balance. Okay, and then this was actually on the exam. So what about, I'll throw this out to the folks here. If you want to type it in, you want to type in something. So what about this? Our park salaries were 175 budgeted. We spent 160. So does that affect the fund balance? The current year fund balance? I don't know if someone wants to type in. If anyone, let me know, John, if anyone's typing in.
Not yet.
Not yet. Okay. Maybe they think it's too easy. I'll wait. And then the next one, so on 12/15, the mayor and council passed a resolution canceling excess police salaries, 20,000. Maybe if someone wants to put that in, would that affect fund balance? Anyone typing in?
The only person typing in is Bill Holman. He said this question was on the June 7th, 2023 CFO state exam. So
Right. Bill and I worked,
down the head.
Bill and I worked closely together. Yeah, this was the one. So let's see what happened here. So we start with 922,500. So our surplus was that we anticipated was 645 in the budget. Our balance was 277. So the excess tax collections were 96,000. If we go back to our revenue schedule, that's where the 96 comes from, right there. Okay. Our delinquent taxes were, the excess was 77. Okay, and so our excess miscellaneous revenues were 704. All right, down here. Okay, 704, that's where you would pick that number up. Okay, so, and then what happened? You had non-budget revenues were 62.5. Current year, we did, again, the police salaries, they affect when you cancel your current year appropriations, that 45.2. Okay, I used to do that a lot at the county, especially if I had my revenues were not coming in as they should. I would go into some of my appropriations and cancel them to generate some additional surplus. Again, but mindful that, you know, that does affect your future appropriation reserves. But if I needed some to muscle up the fund balance, that's what I would do. Getting back to my questions, the park salaries, the current year park salaries, that excess goes into appropriation reserves. So it does not affect, obviously, I know we all know that, but it does not affect our fund balance. So we regenerated, oh, geez, I'm sorry. I have my apologies for that. I think I have my Thinkorswim trading thing on it, and the market's open. Current year, okay, police hours were 20. Current year appropriations, the debt service, okay, the extra 10,000 goes into our operations. Okay, so our fund balance, we went from 922 to 1,293,000. So we had a pretty good year there. So again, it's good practice to, I would try to do your fund balance maybe on a quarterly basis. If you're a municipality, county, definitely I would do it on a monthly basis, tracking down. But again, because it does identify areas, again, if you're missing out or you're not hitting your target, maybe there is a problem, you know, in one of your revenue collection. And so when you're analyzing your revenues, I had for example, I remember a few years ago, I noticed in the clerk fees, they were way down, and I called the clerk, and I knew real estate, again, real estate was gangbuster. And I said, why are revenues down? And so I find out that apparently there were a couple of retirements in that department, and someone was sick. So they weren't processing the realty transfer tax. So, you know, I spoke with the clerk, and we put an action plan in where we had people working on Saturday and Sunday to catch up on the revenue, catch up on that revenue. So, and then in a couple of months, we were back up to par. You know, had we, you know, not done that, you know, who knows what could have happened with that revenue. Okay. Do you want to do the first poll question, Bud? Or
yeah, Joe, sounds
oh,
good.
Joe.
I'll launch it.
Yeah, I figured that.
Perfect. Okay, so all right, the first question is up on the screen and says, do you prepare a monthly cash flow statement or fund balance projection? I'll give everyone a minute to answer and then share the results. And again, make sure you guys get in the polls for credit. And if you have any trouble, feel free to send me an email.
Joe, I thought that bell going off was a reminder to ask a question.
No, that was my think or swim. I figured I'd do a couple of trades after.
He doesn't just teach it, he practices it. So
Well, now you got to tell us what you're buying, Joe. We want
Yeah, I got you know what? I got a couple of options expiring. It's option Friday.
Okay, so
Yeah,
looks pretty split here. Yes, no.
okay. All right. Okay. So yeah, you know what? It's good practice to do it. I guess like I said, it does have value for sure. Let me see if I can move. Okay. All right, great. Any questions? We're okay with all of that? Perfect. If there's not, all right, so fraud. Preventing fraud. You know what? I should probably change to, I think I changed the title to mitigating fraud because fraud is very difficult. You've got to be on, it's a daily game that you have to practice and work on because these fraudsters, they're always ahead of the game. And it's kind of amazing. I said, geez, if these fraudsters, they're so smart. If they put their mind to like having like legitimate legal enterprises, they'd probably be like, millionaires. But again, we got to be careful. Again, internal, you got stealing, obviously mishandling of currency and checks. Misleading, mishandling, forging receivables, deposits, reconciliations. Yeah, I just wanted to share a story with you. Maybe, I guess this was about 20 years ago. We had, I think at the county nursing home, we had one of the clerks, I guess the term is kiting when you take receivables and, put them in your pocket. They have patients' receivables, and so she was stealing. And but the way she was getting rich, she would take the bank statement and doctor it up. I guess changing the beginning balance and changing, and then in her file, obviously she would doctor it up and then make a copy of it, doctor it, and put that in the file and get rid of the original. So it worked out until the end. Obviously, the auditors caught that. So I'll throw out the questions. How can an auditor catch that? Anybody? What did the auditor do? Which I think auditors should do more of. But what did the auditors do? Any idea? Anybody? John? What did they send out? The auditors usually send out, and sometimes I don't know. I'm sure Bud Jones sends out audit confirmations. So they sent out an audit confirmation to the bank. So obviously the bank, the ending bank balance didn't match the doctored, balance. Plus, it was kind of suspicious. Like they didn't have an original bank statement. It was a copy of the original. So, but yeah, the way it was caught, it was an audit confirmation. It was a third-party audit confirmation, and so we were able to find the fraud, and so that person was promoted later. I'm only kidding.
Joe, we had a number of auditors chiming in with the bank balance confirmation.
Yeah, good. I'm glad that's
And Joe
good.
Kowalczyk too.
Oh, there's Big Joe. Yeah, we know Joe. So that caught. So yeah. So important to get those confirmations. Obviously, there's corruption, collusions, misuse of P cards. Oh boy, this is, there is an LFN 2013. I think there might be some updates, but make sure you're spending, I had a P card too. I didn't realize what a P card, it's, you're really not supposed to spend it on hotel. It's really only for, like, I think the sheriff, I think that it's the sheriff department can do it if they're extraditing prisoners, but there are a lot of, I didn't know, geez, but again, you got to do the training and read that LFN. It's kind of very limited, but there are misuses of P cards. If you read the, what is it, the Comptroller General reports, there's always someone doing something with a P card. Again, there's also dealing with financial statements and fraud and reporting. Okay, what are external? We all know cyber threats, and these are big. Phishing, these emails convincing you to send sensitive information. Smishing, it's phishing with text messages. I get these messages, the IRS wants to talk to you or whatever, that's all BS, spear phishing, email, it's an apparent trusted sender instructing the recipient to send sensitive information. There's also voicemail impersonation, boss of vendor to turn over information. We have that. I'm sure you've been aware of that. There's check manipulation, credit card, again, with checks, got to be careful with, like, these mobile, someone gets your account, and then they make a checkup, and then they deposit it mobilely. It's just, we'll get into positive pay, but that's a big thing to stop that stuff. Manipulation of vendor information. Impersonation we talked about, and again, in case your director is going to a conference, and if a fraudster knows that, they could impersonate that. So usually, be careful. I don't know if you're kind of a high-ranking decision maker. Maybe, I know you want to be efficient on your Outlook, but sometimes if you type in, I'm going to be out of the office, for a week, and I'm going to be out of the office. I don't know, that could be a tell to a fraudster if you're out of the office, and maybe they could spring into action, if they get a email respond for you. So be mindful of that. I generally don't do that personally on my end, but that's this is actually a case study, El Paso, Texas. So what happened here? So this was El Paso uses EFT to pay vendors. So the employee received an email from a scammer posing as a vendor. They had a streetcar project. It was a major capital project. So the employee receives an email to redirect the payment and bank information. So basically, we're closed our account, please send our future payments to, this is our routing number, and Again, employee did not verify the validity of this request. So the government the El Paso sent 2.9 million. This is an actual issue, case study. 2.9 million went to the scammer. El Paso was able to recoup 1.6 million, and they lost the difference. So, like, what went wrong? So one person was designated to make the change and submit the changes for EFT. So you had, again, you didn't have an approval process, or you had one person making the change in the vendor system and nobody approving it. Okay, so this vendor employee did that, and no one approved it. No one sought additional validation, as I just stated, and it took this, I think, was a problem. It says it took 2.5 months error to be caught. So that's telling me maybe they're not doing their bank recs on time or consistent if it takes 2.5 months to find a big problem like that. So this is GFOA, strategies to mitigate electronic vendor fraud. Again, we need segregation of duties for staff members, especially changing vendor information. Should definitely have someone initiating, someone approve it. train and empower accounts payable staff to routinely ask questions of both the vendors and department staff. Use telephone or faxes rather than emails to address issues with vendors. Have AP manager, supervisor review and approve these changes. Do not rely on email confirmation changes to the vendor payment. Okay. Conduct internet search or validate street address and phone numbers provided. So that could be, something that you could take a look at. Remove vendor change forms from your government web. Yeah, I guess if you have this on your website, I don't know if anyone has that vendor change forms, maybe you should take that down because you're, that's kind of inviting people then to fill it out and then email it back to a clerk or someone. And have vendors contact directly the staff. If you're aware of the fraudulent account routing and numbers, notify your bank and law enforcement. Okay. Cybersecurity, that is big. That is big. All right. We do have geopolitical that are affecting this. As we know, Russia, with this war in Ukraine, and obviously we're on the Ukraine side, and there's a lot of issues going on with Russia. I do think I know of one county that got attacked, and I think the FBI got involved, and it seemed to that generated from Russia. So also China is on the list, facing the US. They're always attacking. Phishing attacks continue. Again, wire transfer attack, again, do training with phishing with your staff. It's, sometimes, I'll be honest with you, I failed an email recently. So, but again, the banks are always doing these tests, and, so someone sent me, again, our bank sent me an email like, hey, do you want to keep your, again, I always hate changing I got so many passwords. So they sent me an email like, oh, you could keep your password, if you want to just click here. And me like a dummy, I clicked it and I got nailed to saying, oh, you failed the test. That was a bank test. I can't do stuff like that. So I don't know if you have that type of training, just to make people aware of what's going on with these emails, with these phishing.
Mike Carino had a comment for us.
Yes.
He was saying that common ploy for payroll direct deposits, all email instructions need to be reviewed.
So could you say that again? I lost.
Sure. Mike Carino had that this is a common ploy for payroll direct deposits. All email instructions need to be reviewed.
Oh, yes. Yeah. Very important. Yeah. When you're doing direct deposits, exactly. Good thing, I think on a lot of portals, sometimes if the employees, if you give access to your employees to the portal, they could make their own changes so it's controlled that way. The only thing is, I guess, if somebody gets an employee's sign-on information, they can go into the individual employee and make those changes. But one way, instead of maybe relying on a clerk, so a payroll clerk to make all the changes, maybe you can give access if your payroll has that ability, and you have your employee itself log on and make their changes to their, so that could be one way to combat it.
Joe Coons
Yes.
also had a comment that they only allow direct deposit changes in person by the employee only.
Yeah, that's probably smart thing to do. Yeah, I agree with that for sure. Again, these are some facts that I got. Global cybercrime damage predicted at 10.5 trillion by 2025. So it's big. Global cybersecurity spending will increase by 1.75 trillion from 2021 to 25. I think I got this. I should put the source, but I believe this is GFOA. Ransomware. I'm sure we all heard of ransomware, and local governments got hit. Again, they're expected 265 billion by 2031. So yeah, ransomware is very, very big. We had, again, I'm obviously not mentioning clients, but we had a small town, and I don't know, they wanted they requested they wanted to transfer money to Nigeria, and we said, wait a minute, so we called them like, this doesn't make sense, what's going on. And what happened was they were keeping it hush hush. They got ransomware, and they were going to send the money to Nigeria. So anyway, we told them don't do it, and actually our team kind of sprung into action, our cyber, and helped them out, and definitely mitigated a lot of the damage. So just don't, you get hit cyber, don't, again, contact your authorities, and and have a plan. Just don't send money to Nigeria or whatever. That's not right to do that, for sure. But thank God that wasn't as bad. Another important thing is and develop an incident response plan. Work with your, more small towns obviously don't have IT staff, probably have an outside contractor. I know at the county, again, we had a pretty good, Bergen, we had a very good IT department. And so, we were always working on this incident response plan, threat identification, what you have to do a business impact analysis, a review of the security. So very, very, very important to have that. And the thing is, you have a plan, it's great, but make sure you test it. And I'm not sure if people heard of it, but this is what you should maybe reach out to your contractors, the security contractors. Do a table, ask them if they know, hopefully they know what a tabletop test is. Tabletop test is meeting to discuss a simulated emergency situation, discussing concrete plans to manage the fine details of an occurrence, okay, of a natural human-made disaster, and the popular modern method of laying out and testing your organization business continuity and disaster plan. Like what you're doing is you're running through a disaster scenario, whether whether there is a shutdown of your systems, or whether there is ransomware, or run through that test. And again, everyone should know their roles, get everyone on the same page, and again, it helps you train. It's an important organizational training to mitigate these cyber attacks. So let's go back. So yeah, so test. And the important thing, let me go forward. Yeah, I wanted to talk, besides that, your offsite storage, the technology, your cyber, it's going to also address your storage. What do you do? You could be offsite, or you could be in the cloud, or both. I think it probably makes sense to have both, have an offsite storage and have a cloud-based. Also, you definitely would need at least 2 backup facilities, 2 to 3 backup facilities, to make sure, and the important thing is, do they work? It's great to have these backups, but, have you tested them? So that's important, because obviously when there's a problem happens, and then for some reason, some part of the structure is not working, you could have problems. You may have to recreate your records if you don't have the adequate backup. Again, we talked about team member training. Again, I know at the bank, they're very big. We do these micro webinars on cybersecurity, how to prevent, identifying these crazy emails. So it's important, you know, maybe, you know, to get that technology to your staff, you know, and make sure that they're properly trained. Multi-factor I can't talk to Kate. Authentication, you know, make sure when you're doing transfers that, you know, you're doing a transfer, you have some type of token, someone has a token. It could be a hard token or soft token. So make sure that you have that, you know, insurance. I guess we're all, I guess, you know, if we're all in the JIF or whatever, we all have cyber insurance, very important. Understand the coverage, it's important, and the definition of ransomware. You know your policy. Have a data breach coach, or someone, again, at the bank. Obviously, we have a, you know, we've got a team. We've got someone who's in charge with cybersecurity director. Obviously, the bank is always, you know, that's where the money is, and that's where, you know, so we're getting attacked every day, and so that's, you know, we put in a lot of money into our defense systems.
Joe,
am I
before
good
you-
with time, or I think I'm looking at the clock.
Yeah, there's just a couple of comments that kicked up while you were going through.
Yes.
The one I'm looking at here is always look at where the email is coming from, right? We talked about the spamming, and it's if you hold the mouse over your email, you'll see where it's coming from. We do this in our office as well. We get you know, our IT department sends us fake phishing attempts.
Okay,
So
good.
we're clicking, if we're too quick to click, they call it, or I mean, it's been a campaign that we've been doing here in the office for a long time.
Yeah.
We used to go to cyber jail for failing it, and access restricted to certain things. And the other comment was from Joe Kowalczyk. It was that there's a cybersecurity through the mail.
Oh,
So-
okay. Oh, good. That's training, I guess, or
Joe, I don't know if you want to kick in. Is that training?
Yeah.
Yeah, it's training and also a program that they have.
Oh, good.
They can direct you to assets that can help you deal with the cyber issue.
Gotcha. So that's important. Good.
Yeah, they're also forming a cyber JIF this year, from what I understand.
Oh. Very important.
Joe, I'm going to jump in and do your second polling question.
Yeah, sure.
if that's okay.
Exactly. Sure.
All right. And this next one is, oh, can you guys see it? Wait. This one is, does your government have a cyber incident response plan? I'll give it a minute for people to respond and then share the results. All right. All right, it looks like we got mostly yeses for that one.
Oh, good.
I can't
Perfect.
really- Thank you.
Good to know. How much time do I have? So I'll.
Oh, you've got about 4 minutes.
Oh, okay. All right. We'll go into utilize your bank. Utilize your bank. It's important. Let's see. I'm on here. Okay. Again, use filtering or blocking options. Like you can have ACH blocks to prevent or posting of debits, you know. So, you know, talk with your bank to set up these filters could definitely help you. You know, positive pay is very, very big. Hopefully we all are on positive pay. Again, you send the file to the bank. You know, most software have the downloads, and you just boom, send it to the bank. It has the payee, you know, the name, the amount, the date, you know. So when a check is presented at the bank, it's got to match the file. The rec tools we mentioned, with the online banking, you could, you know, do a bank rec on a daily basis. So considering consolidating accounts, I think that's a good, you have a lot of accounts, there's a lot of maintenance that you have to do. Another one, check with your banks or local jurisdictions annually, see if your tax ID number is associated with unauthorized accounts. That's always a good little check to do. So get your, because someone could get your tax ID number and open up an account. So be careful of that. Use secure channels when communicating with a bank. It's important. Review signature cards and authority level. Limit access to individuals. Yeah, make sure, like, if some people leave and so forth, make sure we may not know that the administrator left and so forth. So make sure that you let the bank know about the signature cards and so forth. We talked about tokens, using multi-factor for the online banking services, very important. Have strong, strong line of communication with your banker, positive pay, third-party verification program, alerts about prevent fraud. Usually most banks are pretty good. And, when there's a suspicious, checks, I'm sure you get called. I know we're always calling and verifying if something, because we do have filters on our system. If something unusual pops up, especially, a wire request to Nigeria, of course, that's going to, set up, big red flags all over the place. So I don't know if I don't know if anyone agrees with this, but how about using a standalone PC to do bank transfers, something maybe directly connected to the bank and not connected to the internet. I don't know, maybe that might, that might help, so, you have no internet interference, maybe a direct VPN could be something that we can do. We talked about the blocks and filters. Okay, just trying to see, reconciling, use phone to call bank. Yeah, important on the bottom here, use phone to call bank and vendor any changes if you receive an email. So again, talk to us, if you get an email, call us, and usually that's going to solve a lot of problems. Okay. Checks. Again, I think EFT payments are probably our future hope. I know a lot of us are using it because when you mail your check out, it's out there in the universe, with our routing number and account number. So, maybe EFT payments, we're going to be doing more of those, probably makes more sense. I mean, obviously there's fraud to that too, but at least your check account and check routing number are not being out in the universe. Let's see, this is GFOA utilizes, yeah, the GFOA, they're pretty big on EFT payments. Again, strategies to mitigate the vendor fraud, corroborate, review vendor information. We talked about that. Obtain insurance policy, obviously we have that. Coordinate with IT, establish and maintain up-to-date systems, security and email spam filters are important. Oh yeah, this is important too. Consider when you have third parties, right? And maybe Bud could talk to that. Is I'm sure when you do an audit, Bud, you ask for I think it's called a SAS something form, but now it's SS16, where, if you have other companies doing work for the municipalities, we got to make sure that their systems are up to date. So we got to get some type of third-party audit on their systems. So I don't know, Bud, if you deal with in your audit process.
Yes, we do.
Yeah, what do you
for a
get?
number of different types of entities, payroll companies. When you're auditing GIFs, you're looking at third-party claims administrators. So yeah, and anyone who's doing any processing of transactions on behalf of the entity being audited.
Right, because you want to make sure that they're strong, because obviously if they're a weak link, it could affect your operations. So
Absolutely.
yeah, so But yeah, I don't know. Is that good, Katie, or you want me to keep on? I could keep on going, but any questions?
Couple of questions, comments popped up while we were talking.
Sure. All right, we'll go over the question.
So Bill Homer says, should we receive a monthly analysis of compensating balances from the bank?
Compensating balances, is that related to the fees if banks charge a fee, or that is just everyone will get a statement, and then obviously if you have, I'm sure every bank has online portals, so you can go and check your accounts on a daily basis.
Okay. And then he follows up with, when using electronic payments, is the vendor account information maintained on the municipality server?
What was the question again?
When using electronic payments, is the vendor account information maintained on the municipality server?
Yeah, I don't know. I guess that's on the municipality side, I guess, when you're saying at an EFT payment. Yeah, I would think you would have to, you would update in the, in your, in your accounting system, and hopefully backed up to the server.
Right.
Yeah, on that. I know when I was at the county, I brought in this system called Pay Mode X. Okay, where we did EFT payments, but I had Pay Mode X. They had the vendor information. I didn't want the vendor. I didn't want the vendor account numbers, routing numbers on my system, because I was worried that someone's going to go in there and get a vendor information. So what happened was I would do like a batch. We would send the batch payments to Pay Mode X, and they kept all the vendor information on their system, and then they would submit the they would submit the payments to the vendors on that. So yeah, I guess you got to be mindful if you're doing EFT payments directly. Somehow you're going to have the your vendors' sensitive information on your accounting system. So you got to be careful that some employee doesn't go in there and get that information somehow. So you'd have to build, either black it out somewhere, or I'm sure there's somewhere where you can hide that information or limit it to certain people having that access. So maybe that's kind of, I think that's maybe what Bill's going with that.
And then Joe Coons is pointing out that in Clifton, ACH information is stored in MSI, and that Clifton does have a standalone computer with its own internet access, no access to servers. So.
Oh, perfect. Good job. I like that. That makes sense. Yeah, so maybe we can take a cue from Clifton.
Yep. And Bill Homer's just following up one time here. The analysis of compensating balances would indicate if the earnings credit would cover the cost of monthly transactions.
Oh, okay. Yeah, that's more for the, yeah. So yeah, I mean, I don't want to plug our bank, but we don't charge fees. So we're, I have a simple, yeah, but that's true. If a bank is charging, you got to know if your bank has a requirement for compensating balances and reserves and fees. Yeah, so you got to get that that report on a monthly basis, because sometimes, again, in a low interest rate environment, you may be paying fees. Probably not in this environment, but yeah, because every month they'll show you a detail of all the fees, and what the cost of those fees are. And then they would put, okay, then this is how much money you had. This is how much the earnings credits. And hopefully, if you're in an arrangement like that, you know, hopefully your income exceeds your fees, you know, but yeah, so I know, but yeah, now I understand. Yep, that question. Hope that answers it. But yeah, get that, very important. Yeah, get that analysis, because again, you're analyzing your interest. You want to maximize your interest income, and you know, obviously, if you're, you know, paying fees and so forth, and you know, it's you know, again, there's, you know, not just us, there's other banks that don't charge fees for municipalities besides our bank. So but yeah, that's all I'll say on that one.
Well, there's no other questions there, Joe. So I think great job, great timing on it, right? If we were
Perfect.
about if we were going to be able to make it go this long or not, and I think you did a really nice job, and I appreciate the presentation there. So thank you.
Thank you, and thank you everyone for listening. And yeah, if somebody wants that, again, I'm going to clean up that cash flow model, and if anyone wants it, you know, I don't know, maybe send an email or through John or whatever, or through Katie, and I'll get that out to the folks if they're interested.
Great, thanks, Joe.
Okay, thank you everybody for listening.
All right. Get the screen back here. Katie, are you able to get us back?
Sorry, let me see. Sorry.
Okay, so as we go into our next topic here, we're going to discuss reserve establishment and management, including tax appeal management. Our two speakers today for this are Jason Gablov and Karen Fernaro. Read your little bio here. Karen Fernaro is a certified municipal finance officer and a qualified purchasing agent for the borough of Chatham. Karen started her municipal career in 2012 for the town of Dover. I've had the pleasure, I'll just interject, of working with Karen in a Warren County town. And Karen has moved on. From there, she moved on to the township of Mendham, where she earned her CMFO and QPA. In 2020, Karen transitioned to her position in the borough of Chatham, where she oversees all finance, purchasing, and personnel functions for the borough. Jason Gablov. Jason is a certified municipal finance officer and has an MPA from Seton Hall University. Jason offers more than 25 years of experience of municipal finance experience. He currently serves as a township administrator and CFO for Mendham Township. Jason was the CFO of the township of Millburn for 18 and serves as a part-time CFO in the borough of Netcon since 2000. He's the past president of the GFOA of New Jersey and past chairman of the Morris County Municipal Joint Insurance Fund. Jason is an instructor at Rutgers teaching the municipal finance courses to those seeking certification as CMFOs in the state of New Jersey, and an adjunct professor for Seton Hall University MPA program. Jason has also been a guest speaker for the New Jersey League of Municipalities Conference and the GFOA of New Jersey Conference. With that, Jason, Karen, I turn it over to you, and here we go.
Okay. Jason, do you want me to share my screen? Hold on. Oh. Can everybody see that?
Yes.
But is it not the full slideshow? There we go. Is that, can you see that as a regular slideshow?
No, I still see the tab up top.
There we go. Is that better?
Yes.
Here you go.
Okay. All right. Jason, you're on mute.
Okay, there we go.
All right. Jason, you want to start us off?
Sure, I'll get going here. I think you have control of the slides though, so.
Yeah. Okay. All right.
There we go. So some of you have probably seen some of this before. I mean, everybody, most of us on here are CFOs, and I think, you know, a lot of this are things that we do, and on a regular basis. And sometimes it's a little bit difficult depending on the town and the thought process that you're dealing with governing bodies and what their feelings are on where they want their taxes and fund balance and those things to go. So it's not always that easy. But I think everybody gets, we deal with all of these things every day, right? And more there's things being pushed down with new constraints. Throw in this year what happened with the state health benefits fund, throw in what happened this year. If you were out, or last year with your garbage and recycling contracts, if you had to get out into that market, the new stormwater regs. So with all of those things going on, how do you actually build any reserves? I think that's the trick, and it's not always that easy. So if you can jump to the next slide. Good, right? So in a perfect world, we wouldn't even have to be wishing, right? I go through this with when John Reinhardt and I do our elected officials training, we talk to them about, it's not about wishing. There actually has to be a plan, right? Whether the genie in the bottle's not coming, you can blow on as many dandelions as you want. It's not going to help you get through your budgets and build those reserves. Can jump to the next one.
Yep.
So thanks. So this is just a little bit of an anecdote from a class, my Seton Hall class. And basically this is based upon, it was a city out in Arizona, and I don't remember which one. The new city administrator who had been there for it was only like 6 months to a year. And if you read through this whole case study, he didn't last much longer than that, because his forecast for his revenue and budget was, and this was a quote from their local paper, was completely based on hope and inspiration. You've heard me say it for years, those of you that had me in classes, and Joe and John, and we talk about this. Hope is not an action plan. You actually have to put something around it, and it's not always that easy, as I said. There was another member of the governing body who was not happy with the city administration's forecasts being based on hope and inspiration. Basically, you can't say you're going to fix a $20 million budget hole by doing nothing. It's math, not magic. It just doesn't work that way. It became obvious they were building on a house of cards that wasn't going to stand. So, I think keep those things in the back of your mind, right? There has to be some kind of a plan. And again, it's a plan. Plans change, things happen. The economy is very different now than it was even a year ago. So all those things play into maybe our best laid plans turn out to go a whole different direction, but at least there's kind of some direction to move in. Okay, we can jump to the next one.
All right.
So Karen, feel free to jump in anytime.
Sure. Well, obviously, like you just had mentioned, it's very important to be prepared. We deal with a lot of different financial things that are thrown our way between cap laws, regulations, the rigidity of the local finance board. We have to deal with rating agencies and how our decisions affect how the rating agencies see us. So it's just so important to have an overall plan, which takes time. Plans always take a lot of time. I know for the municipalities that I've worked in, our plan has always been to project out our budgets and to see how we can maintain and build our fund balance while that impacts the taxes. And obviously your debt always plays into that. And how are you going to fund your capital projects and still fund your reserves, your rainy day funds, basically. So I've always, at least in Chatham Borough, we review the plan on an annual basis. Around budget time is when I report on it. We have specific indicators that we measure when it comes to debt, like our assessments, our collection rates, and that all becomes part of my budget presentation, kind of towards the back of it, just to let the governing body know how we're doing and how we're doing with the plan, how our fund balance levels are doing, and any projections that I see moving forward. So here, at least in Chatham Borough, it's a very collaborative effort. Luckily, I have a really well-informed finance committee. I know not all towns have that, but it is a collaborative effort, and we do involve the governing body to a certain extent when it comes to the goals and objectives of the town. I don't know if you have anything to add, Jason.
No, so actually, it's good, actually. It's kind of worked out that Joe went first because we were debating yesterday on who was going to go first. And Joe, I think he's still on here. So I thought it was interesting looking at all the things around cash flow, because that's almost the starting point, is really understanding your cash flows, because then you can start looking at how that impacts and really starting to look at where you can maybe build some reserves, especially just starting with your fund balance levels and going from there. So I thought it was a pretty good time when I saw Joe's information, and I think helpful as we kind of go through our slides.
Yeah, I thought the same thing, especially when Joe mentioned projecting out your fund balance and not just doing it at the end of the year. Because how are you going to know what you can kind of squirrel away?
Yeah.
You don't know what you're going to be able to regenerate for your fund balance that year.
Yep. And I think so I've only been in Mendham now for just about a year and a half. Now I was a little bit lucky, and I'm going to give Karen and I think Debbie Bonanno's on also the credit, because they were here as the administrator and CFO. And they did a lot of work to position the township in a good way. So I got lucky. So it was easy when I came in. But one of the first things I do is I start looking at where the reserves are. I just kind of want to have a sense of the look forward, and we all have our own version and our own tweaks, but it's going in. The first couple things, and we're going to talk about debt and capital later, is there the beginnings, or is there any kind of plan going forward? And where you sit in reserves, and then the cash flow. Those were kind of the three big things I started to look at, just to give me a sense of where the township was going and what kind of position that we were in.
I'll go into this slide pretty well.
Yeah. So there's all kinds of different reserves out there. There's always debate on what are the levels, and I don't know if there's necessarily a right level. I think the rating agencies have a different sense than maybe some of the sense that we have of what's going on in our own town. And I think everybody on the call, and I hope to see more questions pop up or even comments, because that's it's a little bit different trying to do this virtually. I enjoy the feedback, so feel free to jump in. I know towns that'll talk about the Storm Recovery Trust, which used to just be that snow trust, right, covering the cost of 2 winters, which is probably reasonable, because maybe it only takes 1 storm to blow through that reserve. We were lucky with a good winter this past year, so maybe this year you don't have to go as heavy and build that, because you probably didn't dip into it. What that right level is there, I've heard people tell me everything from 1 storm to 5 storms. Again, 5 storms might be overkill for me. Animal control costs. We ran into an issue back in Mekong years ago, because we had a grant, which was covering a lot of kind of the vet fees and things that were going on. So, and my bad as a CFO, we weren't really thinking about the fees associated with that. And all of a sudden that grant went away within 3 years, and we were like, oh, what do we do now? So instead of really looking at the cost versus fees, we relied on essentially this grant that the town had gotten, and ended up in a little bit of trouble there. So then we had to go back and adjust those fees. So you always even have to look at your smaller things like that. Affordable housing, I don't deal with a ton of that, but if you do, make sure you understand what your obligations are.
Yes, that's important. And I think you also have to understand what you can spend out of that. Especially for your professional fees, we ran into an issue here in Chatham where I guess they hadn't really done an analysis of the expenses that were going out of it, and we had to pay back into the Affordable Trust, I think over $150,000. And luckily we were able to use it from our reserves, but we had overspent it because there was only a certain amount that you can use for your professionals. So you also have to be aware of the limitations with some of these trust accounts, because we were charging, and they had for years, had charged a lot of the professional services against the Affordable Housing Trust. And so we had to go back and pay it back. So, and that was a little bit tough because here in Chatham, we don't necessarily have a robust fund balance. We're just really starting to establish our reserves. So it was a little difficult, and it really definitely took a hit to our appropriation reserves and then our fund balance moving forward, because we couldn't lapse as much as we were hoping. So it's important to note that.
Hey, Karen, it's the based on historical collections for your affordable housing trust, correct?
Yes, and I believe like you can only do 20% for professionals, something like that.
Mhm.
And we had far exceeded that. Even
Yeah.
though we had a few $100,000. I mean, the trust was large, so but I guess when they did the measurement, they had done the measurement for a few years, not necessarily an annual measurement. So that's where we kind of had an issue.
Right. It's based both on historical collections and historical payments too.
Yeah. But now we know better, so we don't charge anything there unless we do have to use it to actually, we're using it as a down payment to pay for affordable units that we have to build in the borough. So.
Yep. So yeah, if you deal with affordable housing, it's a big issue. Make sure you're on top of it. Accumulated absences. It's changed a lot over the last few years, especially since the state's limited everybody to that $15,000 cap. But you still have to know and should know when your retirees are coming and who those payouts are for, and have a schedule. So year to year, you should be looking at that reserve and making sure you can at least try and cover those retirements. It's not the bigger cities, that's difficult. I knew when I was in Milburn, we were never going to be able to meet that max number, though now it's probably a little bit different since the $15,000 cap. But the idea was to at least be able to build our reserve 2 years out and look at what possible retirements we were going to have and try and make sure we could at least cover that. I think at the time, at one point, that liability, the full liability was something like $8 million. So I knew I was never going to get to that point. So we shortened the scope and said, okay, what do we need over the next 2 years? And that was kind of how we looked at it and went to build that. And all we did with some of these reserves, especially the accumulated absence reserve and our storm recovery, I kept the line item in the budget of $500 so that we had the ability to transfer either at the end of our current year or use our reserve balances to transfer into those line items. And that was how we helped build our reserves. My next favorite one, we're going to talk a little bit more about tax appeals towards the end. But that's
I kind of have a technical question for you on that. So
Sure.
you actually insert a reserve in your budget line item. Because we always had just transferred it, and either via resolution, almost as a budget transfer, and the auditors had always kind of let that happen, especially like, for instance, like storm recovery. If it was a like budget account, like your DPW, they would just let us transfer it over to the storm recovery trust.
So I would say talk to your auditors on which way they prefer that. There was a couple, like the storm recovery, we would kind of do the same thing, but accumulated absences are, I want to say, our tax appeals, and I had one more where we kind of just left a line item in the budget for transfers. But yeah, there's a couple, the storm recovery and actually accumulated absences, that if it was a where I wasn't taking public works, buildings and grounds money and funneling into streets and reserves, that you would probably need more of a formal transfer for. I don't know if Bud or John want to jump in on this as the auditors, but I found it cleaner depending on which one it was. If I had that line item in there, could do an actual transfer.
That makes sense.
Yeah, Jason, you're right. The state likes to see it coming from specific lines.
Right. So let's see. Tax appeals we'll talk about in a little bit. And one of the things that I will tell you with that is in what I did years ago, and I don't have those large, we have no commercial property basically in Mendon Township, so it's a little bit different. We had a large appeal that, and every few years it shows up. So with the Short Hills Mall, and the judge at one point basically said we were $90 million apart on the valuation. The judge said, you guys need to settle it. We ended up kind of splitting the difference with them. And then we had this $2 million refund that we needed to figure out. We took a 1-year hit, and it was before the 2% cap came into play. So we basically built our reserve for tax appeals and built that right into the budget. At that point in time, we just blamed the 5% tax increase directly on the mall. But once that was in the budget, and I don't know, Matt, I'd be curious to see how Matt's handling that now, Matt Larissy, who's now in Milburn, but we always had somewhere from $600,000 to $1 million, $600,000 to $1 million in that line to then build up that reserve, because we always knew that Short Hills Mall and the Hilton and some of those larger commercial properties were going to be a continuous problem. So we always tried to stay ahead of the curve and build that reserve. And then reserve for litigation, not everybody needs that. That was I know there's a few towns that have that. I can tell you, for me specifically, this was a big issue in Milburn because there was never a fight that we didn't take on. So we needed a way to pay for some of the large legal fees. And that's not picking on Milburn. It just, they had no problem going to the plate and saying, okay, well, we have no problem with fighting back on some of these things. So we were able to build up a reserve for litigation to help pay for some of the legal fees that were being incurred. And fund balance. Generally, for most people, this is your largest reserve. And I think I just saw, I'm going to jump to the Q&A real quick.
Yeah, Jason, I was going to hold off until you got through this slide.
Yeah, I only because I saw Mike Reno's comment, and it ties right in with where I was going about the rating agencies. So we just went through a rating here. And one of the things that came back, and actually we ended up getting a AAA, which I was really happy with. And it wasn't just the fund balance. They looked at fund balance plus reserves all together, which is important because everybody talks about the rating agencies want to see a 25% reserve level. But it's fund balance and everything else together. So building these other reserves, looking at utilities, it all kind of played into how they looked at our financials overall, along with having some kind of fund balance policy. One of the things that we've been talking about in Mendham as part of our overall policy is looking at what level fund balance do we need to be at, because we go back and forth on what's the right level of taxes, and we've maintained a flat tax for the last few years. So what I'm trying to get them to understand is long-term, then we need to really talk about a fund balance policy. So we're sitting around 18% of our ratio, fund balance to budget, which is fine. The rating agencies use that 25% number. So we're talking about landing somewhere of maintaining a level between 10 and 15% so that we can reinvest back into the community. And because it's all residential here, it's actually important because there's no swing back to a commercial base. There's no commercial base to eat up anything. So the governing body here is very big on wanting to make sure that we're maintaining a level taxes. And my point is that's all fine, but we need to look at that in terms of fund balance. So we explained our theory and our thought process to the rating agencies when they asked, well, why is your fund balance policy saying 10 to 15%? We're like, well, you got to understand what our base is here. And when we kind of went through that and then they looked at the reserve, we still ended up in a really good spot with them. So it's the whole combination of your fund balance plus all these other reserves.
Yeah. Yeah, I know our policy here is, and what we're trying to accomplish is actually doing 10% of our unused fund balance. So we're trying to exclude what we actually use in the budget and what we would have left over almost as our bank balance. And we're trying to get that number up to 10%. We're pretty far from it, but luckily with pilot money coming on, and we kind of have a plan in place which would help us build that. So.
Yep. Go Go ahead, Karen.
Before we go on, I just wanted to also say that a lot of this doesn't happen overnight either. Especially in a town that maybe doesn't have reserves, you kind of have to look for those extra opportunities, whether FEMA money comes in and you can put that into your storm recovery trust, or maybe somebody leaves early and you can use their salary and wages and move that into accumulated absence, but it does take time. And even if you can just budget a little bit, I mean, we budget about $15,000 every year for our accumulated absence. If we can just increase that by 5,000 each year, eventually it does start to build, but it doesn't happen overnight. And you also just have to weigh your priorities. So for us, our tax appeals aren't necessarily an issue. We don't have a lot down the pipeline right now, at least on the state level. So we know that that's not necessarily a reserve for us to build up right now, because we don't have the bandwidth between trying to build fund balance, our accumulated absence, and our storm recovery trust. So it's kind of like weighing out your priorities to see which reserves are important to your town.
Yeah, I think that's a great point, and it takes time. It's not going to happen overnight. But if you can take small chunks and even spread it out over a couple of years and hit a couple different reserves, you know, in 5 years, you're probably in a much different position.
Yep. Yeah, it just takes time.
Yeah.
Okay. Oh,
So
here's a polling question.
Yes, I will launch the
And
first
wow,
poll.
that should say town. I apologize. That's my typo. That's what happens when you do these things at midnight.
Right, yes, so does your municipality or town have your own plan? I'll give it a minute. And I saw the question come up. We will share the presentation materials after today. When we send out the recording, we'll send out copies of the presentations too. Okay. All right, so it looks like we got mostly yes. Thanks, guys.
Okay, like the PowerPoint. There we go. Okay. So on to capital debt planning and budgeting. All right, Jason, do you want to start? Or you want me to go through this?
No, I can start and then you can jump in. So some of you are probably like, well, what does this have to do with reserves? Sometimes your biggest reserves around all those big capital projects, right? This is where all our big dollars are, from infrastructure to equipment. So how do we start even wrapping our head around these numbers and really figure out what's affordable? So it's got to be proactive versus reactive, right? It's a plan. You can't just wait until they tell you, by the way, this year I need a fire truck. Because I think if anybody's gone out and just for an engine right now, you're talking around $1 million. So if you don't have some kind of plan in place, I don't know how you get to just throwing in a fire truck for $1 million. Collaborative effort is important. Who's involved? It can't just be your CFO and your administrator, your finance committee. You got to have your department heads involved. They know what they need. And then it's your job to kind of try and translate that for everybody else. And then you can talk through what the plan is. And like we said at the beginning, every plan is subject to change. Things do come up. All of a sudden you have a water main break that might throw everything off. Or if you have a sewer plant, everybody who deals with sewer plants knows things happen at the oddest times. So all of a sudden you have to change your plans to deal with those repairs. And it's more than 10 years. And I don't know, shouldn't say I don't know. I find it interesting because the state put, just depending on population, right, your 3 or 6 year capital plan. Most of us, if you're out in the note market, you know your notes have to be paid back within 10 years. So at a minimum, that becomes your 10-year plan. Most of your engineers can tell you the lifespan of their roads. Your public works superintendents and directors know the status on all their equipment. So it's not that hard to start building it out. It just takes time to do it if you don't have anything. And you're starting from scratch, but all the information is there. So how do we project some of our future needs? What are the major projects? Right now, turf fields are big for everybody, right? So how does that work into your parks plan? Equipment, infrastructure, maybe one of the best places to start looking just to get an idea. You use your insurance schedules, right? Most of us have to, if you're, at least I know in the Marsh, Jeff, at the end of the year, we all have to submit our updated property schedules and equipment schedules, right? So that's at least a starting point, and then you can build off of that. And then what about your funding sources, right? Specific capital reserves. Are you building any reserves? If I know 5 years ago that I have a fire truck, that's going to need to be bought by 2023, can I start putting, even if it just gets me to the down payment number, right? Get your down payment put aside, because there's not a lot of places that are able to just pay cash for $1 million piece of equipment, but maybe you can at least cover the down payment, because that now saves your capital improvement fund for other things, and you don't have to keep putting and chasing your tail on just your 5% for those projects for a given year. You now can pay for your mason dumps and your fire trucks, and also use your capital improvement fund and maybe expand your capital plan a little bit more. Maybe you have capital fund balance from whether you're canceling old appropriations or your old improvement authorizations. Always go back and look if there's projects sitting out there 5-6 years old and they're either done or for whatever reason never been done. Check the status, because there might be funds there that you can cancel, whether it's back to capital fund balance or back to your capital improvement fund, or depending on the status, you might even be able to cancel your deferred charges unfunded, which, by the way, your deferred charges should also be brought into your capital plan, because just because you haven't issued debt doesn't mean that it's not debt, right? At some point, your unfunded improvement authorizations, you have to pay for them. So that should all be part of the overall fund. So how are you getting money? Your premiums from your bonds and notes go into your capital fund balance. What kind of grants are out there? One of the things that we did and came out of my finance committee, and we changed a little bit last year on how we were putting in for our DOT projects. We added more roads in, or I shouldn't say more roads, but they would kind of look at the bigger roads and do half and then half the next year, but you kind of weren't getting the same level of funding. So we put in the full lengths of roads and we got more grant funding out of it. So yeah, it was kind of an interesting conversation that came from a finance committee member who was a former engineer and an administrator in another town, and kind of talked about how he went through his process. So we're actually able to do more roads this year because of that.
So the DOT actually gave you more money?
Yeah, I don't know how that formula works, but we got more money out of it than we would have if we split it.
Oh, that's great.
Yeah, it was interesting to go through that. So you got to get a little bit creative, and then pay as you go versus mixed financing. I think we could all sit there and have a debate and probably spend an hour just talking about one versus the other. When you start looking at your reserves and what's affordable, I always base it on affordability. John's not on here. I think Joe's on here though. And I know there's others of you that have gotten to full pay as you go. And we have some slides coming up, I believe, that kind of talk this a little bit. It's not right for everybody. I honestly don't know in Mendham Township if we could ever get to that point.
I mean, you'd have to project out 30 years.
Yeah.
There's so much that happens.
Yeah, there's a ton of stuff, and that's not through the fault necessarily of anybody. That's just commitments they've made going back 20, 30 years on how they were handling open space and some other things. So when we look at it here, it's what can I actually afford in the budget versus trying to get the pay as you go. John made the commitment, and we'll see his slides because John was actually supposed to do this presentation, but got a little tied up. So Karen and I jumped in to rescue him. You guys can make sure that you tell John that I said that.
I don't know,
But one of the things-
Jason, can you hear me?
Yeah.
Oh, yeah, just to chime in, yeah, with that, like I said, on the county level, I know when I took over our capital improvement fund in 2013 was like, for a county was like 200,000. So, which was very low. So, I made a decision to try to build that up every year. Because my plan, again, you have a plan. So my plan was eventually to build it up. I think we built, when I left 8 years later, it was about $5 million. So my plan was to utilize that fund to buy the 5-year property instead, because we were bonding for the SUVs and any type of 5-year property. So obviously the county was so, there's no way we could go pay, or it would probably take 100 years, like with $1 billion. But I figured that, what, if I can at least do the 5-year property, and pay that through the capital improvement fund, that would be, go a long way. So that was, so I guess when I handed it off to John, he had I don't know what it is now. I know I handed off a $5 million capital improvement fund. So, and, obviously he agreed with that thinking. And so I'm sure he's going to increase it over his tenure.
Yeah, and thanks, Joe. I think that's important because it takes a commitment to be able to do that. And it takes a commitment from your governing body to say, we're going to give you more money, because it means you're raising taxes in order to get there. So everybody's got to get on the same page for those plans and make that commitment. And I know that was a big thing when John did it in Wharton. They made the commitment to pay off their debt and increase their capital improvement fund all at the same time. So the front years was probably a little bit more pain, but once they got through it, now they're in a really good position.
Yeah, we're trying to do something similar in Chatham now. We're trying to tie it more to the useful life, where again, if something's a useful life for 5 years, you're going to pay in cash. Most of our stuff is around 10 years, so notes kind of make sense for that. But if we were to do any major buildings, that's something we would bond, just because it gets tied more to useful life.
And Jason, as we go into the pilot and redevelopment discussion after yours, if you have a pilot program that's coming on, and you're going to get this new chunk of outside the cap revenue, you could dedicate that towards building that capital program back up and not and use that as the additional revenue coming in instead of asking for more in taxes.
Thanks, Jim. And that's actually something that we're going through in NECON right now, because they have a bunch of pilots coming on. So we're kind of having those discussions about how do we want to redeploy those funds.
Yeah, that's kind of our, that's because right now in Chatham, we don't necessarily have a really well-developed capital plan, and the fire trucks are really throwing us off because, of course, they haven't replaced the fire truck in who knows how long. So when our pilot money comes on probably next year, that's probably one of the first things that we're hoping to take care of are some of these larger capital projects that throw wrenches in your plan if they weren't well planned out. So that's kind of one of the first things we're going to try and get out of the way.
And I'm just real quick, there's one in the Q&A, and I'm stealing Mooney's job right now. That's all right. And actually from Ray Serenelli, and Ray, I agree. It's not a bad plan if your infrastructure is going to last 20 years to match the useful life with the expense by having that debt paid off over 20 years. I think for most of us, that's actually a good way to go, is kind of try and match your plan to your, to what your actual schedules look like.
Yep. Yeah, because it's really hard to pay interest on something that has a useful life of 5 years. If you're paying that in year 8 or 9, it's just difficult. Like it just doesn't seem right. So.
So the next couple slides, we just kind of have a couple samples, and we all do this a little bit differently. So this is one of the ones that John had started when he was still in Wharton, and I'm pretty sure that Joe's still using it, probably with his own tweaks, because that's what we all do. You get in and you know what you're comfortable with. But this was kind of just looking at their capital program. Red, yellow, green, think of this as a traffic light, right? What they're going to do, what kind of was in the maybe not quite as bad, we can push off, and then the red was just stuff they're not doing right now. So they had a way of weighting this based on value and age, and then obviously how the rest of it fit into the monetary plan. And they kind of tied this, there's a couple other things that go sit behind this that help them come up with how much capital they're going to be putting out in a given year. You can jump to the next one, Karen.
This is actually our high level look at our capital plan. So it's taking kind of a back sheet like this and just funneling it forward into different categories. And then we have a way for us to fund how we're going to fund these, the projects. And then this ties directly into our budget for capital improvement fund. And then the new debt that we take on ties into, I have a whole note schedule of how I would then pay that down. Because we use notes here in Chatham Borough. What I found that's been really hard with capital planning, because Chatham didn't have a capital plan before I came on. So I guess this is probably my I'm going on year 3 here. It was really messy. And as you can see, the capital plan tapers off as the years go on. So I'm now in the process of really taking a close look at the asset inventory to see, what the department heads may be missing, because it's not necessarily balanced. And what I'm looking for is more of a balanced approach where we're investing anywhere between $1.2 and $1.4 million in capital projects each year. And then I have a way that I would be able to fund those through the years. So I'm still trying to tweak it out so we don't have these spikes and then these real lulls. But like as the years go on, all of a sudden we don't have any capital projects, and it just doesn't really make too much sense. So I kind of have to get our department heads thinking more long range than they are. But at this point, it's kind of, this is our high level, how I look at the capital year over year. And now on to debt. Jason,
Yeah. So yeah, I mean, when we look at our capital and you start thinking reserves, debt obviously comes into play. So what restrictions do we have? We have the 2% levy cap, which obviously our debt's outside of that. However, depending on the town that you are in, your governing body doesn't always care about what's inside and outside the cap. Those are the mechanics for us to work through. They just don't want to raise their taxes over 2%. Right. So how do you work your debt schedule within that? It's great. I can tell them we have all this cap banking, but if they're adamantly opposed to raising taxes, regardless of what we may or may not be allowed to do, the 2% does then become a problem. Right. So this is where going back and having a plan. I then have a sense of, okay, here's what I know I can do in debt each year and capital. For me, I look at my debt and capital. Actually, I'm going to mess up a slide in the future here, but I look at it as one number. As one's coming down, I want to, if my debt's coming down, I want to put more cash in. If there's a point where I see my debt starting to come up a little bit, I'm probably going to lower my capital improvement fund money a little bit just to kind of balance it off. And there should be a growth factor in there. And I think we may have a slide from John. I don't know if we left it in or not, that basically showed when they were working on building to their pay as you go, they had decided on, is it still in there?
Yeah, here, this one,
Okay.
right?
Yeah, that one. So it's kind of interesting because what they did here was they had this 4%. So they were growing their debt at a 4% level to keep up with interest markets, keep up with inflation, and also then figure out how much they could pay off to get to where they're at now. All of us kind of do this a little bit differently, but that kind of all ties into the whole thing. Okay, you can jump back up. Sorry, Karen.
Just to jump in here real quick, Bill Homer was asking Karen, what do you pay down in notes each year in your budget?
So this year we pay down 175,000, but we're going to have we're having lapsing debt, and so in 2024 I'm upping that to, I believe, 400,000. I have my debt plan back here, so you'll see here. You'll see I have some. This is our debt plan. So I have some bonds coming will be done in 2024, and you'll see I start to up my principal and I start to pay for more in cash in 2024. And then as things start to lapse, I start to pay it down more aggressively. So in 2030, you'll see it goes up to $1 million for me to pay down the note principal. So we start to aggressively pay more down in 2024. And then you'll see at the bottom, this is just my budget line. How is it being affected? So is it going up, down? So, and I tweak it each year depending on interest as well. So that's why it's kind of there. It does vary a little bit. And then I have some projected debt. Our Post Office Plaza project is our affordable housing project that we're probably going to have to spend $3.5 million on. We're probably going to use pilot funds from a different project to offset that, but I still have that worked in here just so I can see exactly if we didn't have the pilot funds coming in, how that would affect it. And then this all gets tied back in budget projections to the tax impact. So I don't know if that answers your question.
Jump back up one if you don't mind.
Okay, sure.
So the other thing that you always have to keep in mind is, as you're looking at your debt and you're going out for bonds, is the ability to look at non-conforming debt schedules. It depends on the who's on the local finance board, and level debt payments to them are not necessarily just a good enough reason to get approval. You really have to have a plan around it. So all of these schedules that kind of show where you're going are important to get those approvals, because you can't just go down there and say, I want level debt, right? There actually has to be some sense for them that there's a reason that you're looking to either front load or back load your principal, right, to get to a certain point. So level debt's not necessarily the answer they're looking for. So you kind of have to walk them through basically a similar schedule to what Karen had, right? Show them that what you're trying to get to. Not quite that easy. And it also sometimes depends on who you're dealing with down there at a given time. Okay. Long range, right? So when we start looking at debt planning, I think we've already kind of gone through this. All the restrictions is a way to start developing your capital needs. Include not just what you want to spend, but can you actually afford the debt and impact on your budget? We'll talk about a couple of ratios at the end. My thing is not really when it comes to my debt, it's not about my 3.5% of my 3 years average equalized valuations. It's what can I actually afford? And I'm more concerned with my debt to budget ratio, because that tells me really more what I can afford than that 3.5% number. If anybody actually know what their 3.5%,
Huge, isn't it?
it's huge. So in Milburn, for example, I could have incurred up to $280 million in debt.
Yeah, it's huge.
I wouldn't have lasted there for 18 years if I made that recommendation, by the way. Just completely not affordable, right? So that's all part of the plan. And I can't even imagine, and Joe might know the Bergen County number, but I can't imagine how big the debt limits would be on what the counties are. And is that really affordable? So creating a debt plan should allow you to detect those spikes in debt service. I think, Karen, when you and Debbie first got over here to Mendham, because we were working with you at that point in time, we started putting together the debt schedules, and we found what we called the wall of debt.
Mm-hmm.
Because nobody had really layered it out over the years. And it was like, wow, we need to help find a fix. And they just through some tweaks in the way they were going about it, and like working with the auditors and all of us, and I think Mike was there at that time, we kind of created this plan to try and get around that wall, because there wasn't really a great plan at that point to do it. But you guys got it there, and thankfully, because it makes my life a little bit easier.
Yeah, well, I think what happens sometimes too is if you don't have a plan, when it comes to notes, you're paying the minimum, and
Mhm.
now you have a bubble, and now you're layering more notes, and if you're paying the minimum, you have to pay it off in 10 years. So either way, you create a sort of bubble, and I think that's what happened in Mendham.
Yeah,
They
yeah,
just really had a bubble. And
I
you guys really helped with a large tax increase. I think we had an 8% tax increase that year, and it was all for debt service to increase the amount that we would appropriate towards debt service. Kind of
yeah,
where we-
unfortunately, I think our actual recommendation was something like a 15% increase, which we knew they were never gonna go.
Yeah,
But because of that issue, it was, yeah, I going back and kind of jogged my brain. They were just paying minimum payments, right?
Yep.
And it created that huge bubble.
Yep.
So they had no choice at that point but to do that. I think you had 2 years, right when you first started, of a big tax increase.
yeah. Yep, we did.
Yeah, so you want to avoid all that, and that's what hopefully the plan gets you to.
Yep.
You want to start
Sure.
here? Okay.
Sure. So debt planning, where to start? So establish your base. So this is basically figuring out what all your current debt is that you have on the books, and what you have in your appropriations, like what you have budgeted for your capital improvement funds. And then you want to know, like Jason and I talked about before, if you want this to grow in the future, if you if you want to grow your capital improvement funds, or if you actually do need to grow your debt service obligations, if you see these bubbles coming on, it's something that maybe you can layer over a few years to get to the level that you need to be. So that's always a really good place to start. That's where I always started. And then you just really start to map it out. If you use notes, you start to map out your note payments. Again, you may be able to do the minimum payment the first few years. Obviously, you don't have to pay the first 3 years, but you have to ramp it up so you don't create this large bubble at the end, because then it's just really not affordable, and then the bubble just keeps going and going and going. So the combined total will be used to meet your obligations and for providing down payments on improvements, or even fully funding improvements depending on your goals. We kind of already talked about pay-as-you-go versus fixed financing. Everybody kind of has their own philosophy on it, but again, I like to tie it to the useful life. I know some others had mentioned that they do that as well. Right now we are trying really to move towards pay-as-you-go, and you'll see in my debt plan in 2024, we'll start to pay for some of those things, like turnout gear, vehicles, the small like police vehicles. I personally don't want to I don't like to take out debt for those things. At this point, we're not necessarily in a position to do that, but we will be in a few years as bonds fall off. And again, we tend to like bonds for larger infrastructure projects like buildings. We're going to have to be building an affordable housing unit, so we would be bonding that because I believe that would be probably a 20 year useful life. So this is also interesting, and we tried to do this in Mendham. It was a little more difficult because they would always throw a wrench in the annual spending level. But in Chatham, we've committed to between 1.2 and 1.4 million dollars in spending per year for capital projects, and then I'm able to wrap that into my debt plan, and how I'm going to pay off that $1 million, 1.2 to 1.4 in projects. I also include grants to help offset some of those costs, primarily just for DOT projects. We've been getting a lot of trails grants as well, that we also have to kind of put some money in, so that helps offset some of those costs, and I take that into account in my debt plan. And work around exceptions. And if you have a year that exceeds your plan, then the next year you may need to reduce it. I do have to say this year, interest rates have not been great. So I did not take out that much new money. So so that's kind of, I have to make adjustments to my plan, to especially my note pay downs, because I didn't really take out any new money. I'm relying on, our bank balances to help compensate for some of our capital projects. And also, like, as you all know, like a fire truck or some of these larger equipment takes a really long time to get. But I'm going to probably have to borrow more money next year when hopefully interest rates are in a better place. So I have to take into account for that. Do you have anything to add, Jason?
No, I'm good on that.
Okay. So again, these are just the examples. I think we went over these already.
Yeah, we can kind of go past that.
Go past that. These are just the trends to track. Again, I usually track these on an annual basis and include part of this in presentations to my governing body, especially debt as a percentage of budget. But it's always important to track these at least on an annual basis. And it's also good to report on it.
Yeah, that's why I said it earlier. I think just looking at that 3.5% of your 3 years average equalized valuations, it's, we have to track that and it's important, but it comes down to affordability. And these tend to give you a little bit better of a sense as to what you can actually afford.
Yep. Oh, our polling question.
While that's coming up, yeah, that's the polling question.
Sorry, I'll go ahead and launch that.
That's okay.
One sec.
As long as we didn't put Katie to sleep too, I think.
Yeah, nice. Okay.
I think Mooney just kicked her.
All right, you guys should see the next polling question. What are 3 trends that should be tracked in your capital planning? And you guys should be able to choose multiple. I'll leave that up for a minute.
Karen, while we're answering this, Bill had asked, do you have any utilities in your community?
Yes, so we have a solid waste utility that we run our our garbage and recycling through, and then we have our water utility. Our sewer runs through our current funds. It's very important to do the same sort of tracking on your utilities as well. Our utility budgets are very, very tight. Water's not so bad for capital. Again, we're having to invest a lot there right now because of the lead service replacements that we're trying to figure out how we're going to be able to afford. But yeah, we do have those 2. And just as you're doing for your current fund, you have to do for your utilities as well.
All right, so tax appeals. One of the biggest items that sometimes we run into, and the market does not always help us on this, is tax appeals, right? So it's a reality. They do happen as much as we'd like them not to. So how do you deal with them? How do you pay for them? The value of properties right now, right? Everything's completely skyrocketed, probably out of control. I don't know if it's where we were back in 2008, but there's probably a bottom coming at some point here. And then get ready for the appeals. Because once the prices start to drop, we're all going to get hit with a lot of appeals.
We actually just went through a reevaluation, so it'll be very interesting to see what happens. Because obviously the residents, some residents were not very happy because the value of their house is huge right now. It's really high.
Yeah, it's going to be interesting to see how this goes, but it's a good time to really start looking at your reserve for tax appeals, and where that might be. Office vacancy rates, foreclosures, short sales, all of those impact the market values. I'm unique in Mendham because we're probably 99% residential, so our swings are a little bit different. In Millburn, it was a completely different world where we had a large commercial base, right? That, there was always a concern of the big properties, the mall and the hotels and some of those ones off of JFK Parkway. What happens when they appeal? It's not easy. Where does the swing go? Timing on revals, and sometimes we don't get a choice. We just had ours last year. But we just went into that 5-year maintenance program, which will hopefully mitigate future appeals, because now the assessor has some flexibility annually on re-looking at portions of the town. So hopefully that keeps us in a good spot. And I don't know if anybody has a different take on this, but I think Karen and I are kind of on the same page. We don't know what the impact on values really from the pandemic are yet. I think we're still waiting to see where this goes. You know, a lot of people came into the suburbs out of the cities, and maybe bought at the wrong time and drove all the market values up. So that might be all part of what we're seeing with this latest housing bubble. Do you actually talk to your assessor? Right? It doesn't mean that you have to get along and go out to dinner, but you got to communicate. What is he looking at or she looking at? Are they listening to you from a budget standpoint? Because the way that they value, and you obviously can't tell them what to do, but there has to be this open line to understand what credits versus refunds do and how each has a different impact on the budget. So it's important that you have to communicate. If you have a tax attorney in the mix, make that all part of the group that you're talking about, the management of, really it's your inventory, your housing inventory, your commercial inventory. How does all that play in, and what are they seeing in the market? Because at some point, whether if you're the administrator, if you're the CFO, you have to get the information back up to the governing body so they understand what's coming and how that impacts the budget. That communication is huge.
Yeah, and I do have to add, because this did happen in Mendham, we always had an established tax appeal reserve, and it was always a certain amount. And I had always worked with the tax assessor and said, this is how much we have. Do you think this is sufficient? And they had a lot of state tax appeals. I'm assuming, Jason, they probably still do. And he was able to manage it where he could put off some of the state tax appeals because he knew that if he settled it, we didn't necessarily have the reserve level anymore. Like, so he would go up to that reserve level and then kind of stop work on the appeals and maybe push it on to the next year. Because I guess he had that flexibility with state appeals. I'm not actually really that familiar with the process, but it was helpful to have that communication so that he didn't blow through the reserve and then it would hit our fund balance directly.
Yeah, we still follow the same thing. The assessor and I talk on a regular basis, you know, and get a report of what your outstanding appeals are. I always ask for that because it's helpful to know then where our reserve levels are at, what we're looking at going forward, what's still outstanding, because some of these appeals can go on for years. So you want to have that understanding, and then you can kind of build a reserve to that. And, you know, hopefully you end up in a spot where you're not ending up hitting your fund balance.
Just to jump in here, there are a couple of points or questions here. Donnell asks, any reason why you wouldn't move to an annual reassessment / reval? The savings is huge and the market is handled each year. Whatever.
So we just didn't necessarily have it built into our budget, at least in Shannon Borough. But now that we've gone through the reevaluation, we have that money built into our budget through the special emergency. So I mean, even though, so we have those numbers in the budget. So I think we are definitely going to, once we pay off the special emergency, look to kind of moving those fundings towards a rolling reassessment. But it is something that we definitely want to do.
Yeah, we actually moved to that. That was why Mendham actually did the reval last year, and that was part of it. We're now in the rolling reassessment plan. It doesn't completely get rid of the tax appeals. It definitely mitigates them though, and it's a little bit easier to deal with, and we definitely have less than they've seen here in prior years. So from that standpoint, it definitely helps. It gives the assessors a little bit more flexibility when they're looking at properties to go back and review up to the minute, you know, or really up to date values on what the market's doing. And I see the comment.
Go ahead.
Sorry, John, go ahead.
No, go ahead. Go with it. You're good.
I'm laughing at the comment from Bill, and I agree. Yeah, it's unfortunate that we have to eat the school portion of the tax appeal. But on the positive side, when you get your pilot agreements, if you're going through any of that stuff, you don't have to give any money to the school. So we at least win on that side of it.
Yeah. So we kind of touched on this already, the
Yeah.
establishing the appropriate reserve levels, again, the revaluation or the reassessment, and of course, anticipating anything that will happen. And of course, it's the main theme to plan. Plan.
Can't say planning enough.
Yes, yes.
Yeah.
So this slide is kind of paying for your tax appeals. So again, impact on your current year collections and on fund balance. Obviously, anything that from a prior year would either hit your fund balance or your reserve for your tax appeals, and anything, obviously, a county tax appeal would just, I believe, just affect your current year collections. Right now, we do not have a reserve set up for tax appeals, so when those come through, they hit the fund balance, and it's always very painful. So it's something that we need to look into building.
Yeah, Mendham, Nekong, we're in pretty good shape with that. Milburn, I shared this way early on. We actually didn't have reserve, and this goes back to, it was a 2004 appeal from the Short Hills Mall. It was before we had to worry about the 2% cap. So once we knew what the settlement was, we forced that line item into the budget. We raised taxes that 1 year. And since that point, they've always had a line item in there for a pretty significant amount of money. It's the last time I was there, it was around 600,000, but that reserve usually was sitting somewhere between $1.5 to $2 million. So as these large commercial appeals came in, even the smaller residential ones, we could deal with it. Yeah, I'm not telling you, and I don't know if anybody here actually could force $2 million like that into their budget, but you got to start small. Even if it's a couple thousand every year to get ahead, to try and get ahead of some of your appeals coming forward.
Yeah, and that kind of goes into this slide. It's how you set it up.
So a budget appropriation is always the cleanest way to do it because you can transfer into it. A reduction to the amount realized for the current year levy. Again, that's just talk with your auditors about that journal entry and making sure they're good with you making a year-end adjustment. What's the appropriate level? I don't honestly, no, Karen, if you want to take a crack, but I don't know if there's an appropriate level. I think you do what you can.
No, I mean, honestly, again, like I worked with the assessor to let him know what level we had and that he had to try to work within that level. But again, Mendham was not having those large commercials. What Mendham's issue was, these large estates that were bought for $5 million are now sold for $2 million. The neighbor finds out. So those were more of those issues, I would say. So I don't know if, so I would just let him know, and he would be able to kind of push those off a little bit and work within the constraints of whatever reserve we had. And then he would say, well, next year, can you add X amount? And so we would try and build it back up again, or build it to a higher level so he could deal with more appeals.
Yeah, and I like the next point here is, what was your worst appeal, right? Maybe that's the starting point and you build to that, and just kind of keep an eye on where everything else is moving.
Yeah.
And then how you get there, right? Sorry, it's time, money, and maybe a little bit of pain to either realize a little less tax revenue or start to build up a line item in your budget to move to the reserve. It might mean you have to raise taxes to get there. At some point, again, all of these reserves take some time. There's no one way to do this, just time and a little patience.
And just to jump in, there's a few points there that we want to discuss here. Mike makes a note that rating agencies like to see tax appeals in separate reserves. And I'll take that one step further. The state of New Jersey also likes to see you, when you have to go in before the local finance board to defend an appeal or to ask for a payout period on an appeal. There was one instance where I had a town who really had nothing in reserve or very little fund balance, no way that they can set aside money for reserve for appeals. And I almost got a 6-year payback. But the last question that had come up was, why haven't you established a reserve for a tax appeal? And, you know, they were all on board for the 6 years. They wound up giving me 5-year payback period, all because they said that we should have had something established. So, you know, they like to see it as well, not just rating agencies, but yes, rating agencies factor that in when they do their ratings, because they take in all of your reserves before they come up with your rating. And then Bill Homa, it's a shame the municipality cannot adjust the assessment in the tax duplicate as a result of the county board judgment before the tax bill is generated. So.
Should we go on to the next slide?
Yeah, we can go to the next slide.
Okay.
So I don't know if we can say this more than we've probably said it all morning. Planning, and more planning. Long range, you're trying to minimize the financial pressures that we see outside of our walls, right? How do we mitigate some of those pressures? The plan's only good if you use it, right? We have lots of books that sit on our shelves. You don't want your financial planning tools to be just sitting on the shelves and being dust collectors, right? Save that for the plaques that we get from all the things that we may be involved in. That's what your dust collectors are. Yeah, it's got to be an active plan that honestly, annually, maybe regularly, more than annually, you should be going back into and making adjustments to, and just trying to measure impact versus the plan so that you can then make your next version of the plan. And then maintenance, right? That's basically what I was just talking about. Manage the plan, right? Don't just let it sit. Maybe it's twice a year, maybe it's annually. If you have the bandwidth, maybe it's quarterly. Go back in and look at it, look at your results, where you are at a given point in time to what your plan was calling for, and try and make the adjustments when you can. I don't know, Karen, if you have any more to add.
No, I think you covered it all.
Okay. And Katie, are we good on time? Because that's all we have.
Yeah, I think that was perfect. You guys
Okay,
pretty
good.
much made it to the end. Yeah.
Aaron's got to get to that borough picnic too, so, you know.
That's right.
Timing.
Ray, Cody and I are coming down, save us a hamburger.
We're
If
gonna
there's
need
no
to
further
do that
questions, no further questions here, just Bill Holmes saying thank you for your excellent presentation. So, and it was excellent. Thank you very much.
Thank you. Thanks, Karen.
Thank you.
But I don't know about you. Do we want to take just a couple minutes and then reconvene in like 5 minutes here, or keep pushing?
We can do that.
Okay.
I know Matt's ready to go, so's Jim.
No, I'd like to go to the bathroom. That would be appreciated.
All right. So take a 5-minute break, be back 11:25 and keep moving.
Great.
All right. Jim and Matt are here for the next topic. We're going to discuss redevelopment here. Going to give you a little background on both gentlemen. Matt Jessup is a partner with McManaman, Scotland and Bowman LLC and chairs the firm's public finance practice group. Matt and his team counsel municipalities, counties, school districts, and various state and local authorities on the issuance of bonds and notes to fund capital projects. Matt and his firm also act as redevelopment counsel to municipalities and developers statewide on projects ranging from mixed-use residential over retail projects in suburban downtowns to the transformation of the Asbury Park waterfront to the construction of the Prudential Center in Newark and the American Dream Mall in Meadowlands. Jim Burnett. Jim has been working with the Borough of Madison for almost 13 years. He's currently the Chief Financial Officer and Assistant Administrator for the borough. He's responsible for strategic financial management for the borough. He also manages the procurement and pricing for the borough's electric utility. Prior to working for local government, Jim owned his own retail business for 13 years. Prior to that, Jim was on the trading floor of the Prudential Life Insurance Company, managing a portfolio of short-term liabilities. Jim is also an owner of commercial real estate. Jim graduated from Lehigh University with BS in finance, as well as a master's of business administration. Gentlemen, I turn the floor over to you.
All right. Thank you very much, John. Good evening, everyone. Hopefully you can see the full screen of our of the first PowerPoint presentation. Jim?
Yep.
Okay, good. So good morning, everyone. Matt Jessup from McManaman. Jim and I are happy to be here with you all. Wish we could be seeing you in person. We're going to talk a little bit about redevelopment and redevelopment finance. We have a presentation that sort of takes you from the very, very beginning all the way through to the end. We also thought we had like closer to 2 hours to do all that. So now that we're down to about an hour and 5 minutes, hour and 10 minutes, we might speed through the first half. I suspect most of you as finance officers will have more of an interest in the second half of the program, including Jim, who will take you through some of the practical implications of a redevelopment project and a pilot that we on the professional side don't always see, and love hearing these things that Jim's going to talk to us about, because it allows us to learn and maybe implement a little bit better coming back to the documentation phase. So there we go. Redevelopment, I think we all, sort of have a sense of what it is. It comes from our state constitution, and it's governed by the local redevelopment and housing law. And it's really a process that allows us to site-specific, zone, construct, and provide different financial incentives to a project in a way that we as municipalities can't normally do under the local public contracts law, the local lands and buildings law, the local bond law, for example. So there's a broad array of powers that spring to municipalities under the redevelopment law that we don't normally have. And why do we want to do it? Again, we want to take a piece of property that maybe is underutilized. We want to zone it differently. We want to control what goes there. We want to control what it looks like. We want to control or be able to assist in the financing. Perhaps the existing zoning doesn't allow for the density that the project that we're proposing, a residential project, for example, doesn't have the density allowance that we need to accomplish a project. The property may be zoned for 2 stories and we need a 3 or 4 story building to make it work. Do we have RSIS parking requirements in place? Do we really need them in this project, right? Is this a project at a train station, for example, where maybe we don't need such strict parking enforcement? Do we have land? Does the municipality own land that they want to either sell or contribute to make the project happen? whether it's the main parcel of land or an ancillary piece that is necessary to help make the project happen. And of course, we'll get into financial incentives such as long-term pilots, grants and loans, and redevelopment area bonds, whether it's general obligation bonds, revenue bonds, or sort of pilot-backed bonds. There is a whole team involved in the redevelopment process from start to finish. The mayor and council, from my perspective, are really the ones in control of that process. The governing body controls, at the end of the day, what is going to get built, what all of those zoning determinations are, what type of financial incentives are involved, who is the redevelopment entity that is in charge of the redevelopment project, typically the municipality. We'll get into that in a minute. The planning board plays more of what I'd consider an advisory role during the redevelopment process. But then once the project is ready to go, that project has to go before the planning board for a traditional site plan application, at which point the planning board is in its full customary usual role. Redevelopment entity, to the extent it's different than the municipality, and we'll talk about that in a little bit, again, is the one contracting for the project and enforcing the terms of that contract. And then, of course, you have the private developer, right? We need a developer who wants to come in and construct the project. We want their project to be successful because, as we'll see later, their success becomes our success. So there's really two things that have to happen for us to spring the powers of redevelopment. First, we need a redevelopment area designated, and second, we need a redevelopment plan adopted. So we really start with the parcel of property being identified, whether it's by the municipality, by a property owner, by a prospective property owner, and going through the process of declaring that property an area in need of redevelopment. Then we need to adopt the redevelopment plan, which is effectively the zoning just for that property. And then we can move to a redevelopment agreement, a financial agreement, if there's going to be a pilot, implementation, and of course, completion. So the area in need process is a process that sort of bounces back and forth between the governing body, the municipal governing body, and the planning board. It starts at the governing body, who effectively directs the planning board to study one or more parcels. So the municipality says, we know we want block, 1, lots 1, 2, and 3. That's our area right in the center of downtown. We think that property could be redeveloped, could be used for a better purpose. It's an abandoned gas station or whatever the circumstance is, and we want to do something with that property. The municipal governing body refers that over to the planning board. The planning board studies it, and this is where the planner comes into play critically in studying the property and determining whether or not it qualifies as an area in need of redevelopment. That can be the planning board's planner, their regular staff planner, or it can be a planner that is typically hired by the municipality specifically for redevelopment. So even though it's the planning board doing the finding, you can have the municipality's redevelopment planner prepare that report, do the investigation, and ultimately make that report available to the planning board. But the planning board is going to ultimately hold a public hearing. The property owners that are in the proposed redevelopment area are going to be noticed, and the planning board is going to make a determination as to whether or not the property meets one or more criteria under the redevelopment law as an area in need of redevelopment. Assuming they say yes, starts again with the planner. So let's assume the planner says yes in his or her report. The planning board then says, yes, we believe that these properties meet one or more criteria. Then that recommendation from the planning board goes back to the municipal governing body, and the council gets to adopt a resolution declaring the property an area in need of redevelopment. That's got to get filed down with DCA. And at that point, one of our two critical first steps is complete, right? We have a designated redevelopment area. This is sort of a laundry list of the statutory criteria that a property could meet. I don't want to go through all of it. I really wanted to point out two things. One is that while there are numerous criteria here listed, we only need to meet one. Each parcel of property only needs to meet one criteria, and multiple parcels don't have to meet the same criteria. So we have designated areas, specifically sort of scattered site areas where you've got lots on different blocks all over the place, where maybe a couple of them meet criteria A, a couple of them meet criteria D, a couple of them may meet multiple criteria. But you only need to meet one, and you only need to meet one per property. And the other thing that I wanted to point out was B, which is basically discontinuance or abandonment of, among other things, retail and shopping malls and plazas, and office parks. And I bring those up because they're ones that we are now seeing more often, right? We were seeing it pre-COVID, and we're certainly now seeing it a lot more post-COVID. And while those buildings have to be abandoned or discontinued for two years, we're at that point. So when you're thinking about properties in town, the obvious environmentally contaminated ones, again, the abandoned gas stations and properties like that, the abandoned factories, those are sort of easy ones to identify. Ones that we may not all be thinking about right now, but I think may become should be more of a focus, are those office parks where my office is, for example, in Roseland, or strip malls, if you will. We're doing a redevelopment of a strip mall project in Mount Arlington right now, right? That will revitalize the strip mall and provide residential on multiple sides.
So Matt, it's Jim. Quick question, just to go back and forth a little bit. What are so that's obviously one that's popular and used a lot. Some of these I imagine are not used that often. What are the other one or two that are used quite frequently? Is it smart growth? Is it
A is used quite frequently. When you have abandoned or unsafe buildings, old structures. Again, you have discontinued warehouses, factories, things like that. D is used. D is sort of this amorphous category, right? You can tell from the language that it's sort of this more of a field test, and this is really where your planner comes into play, right? The planner is going to do site visits. They're going to look at municipal records and property records for violations, for example, things like that. Their professional opinion on these things becomes really important. And one of the things that we like to do, practically speaking, when maybe a municipality or even a property owner says, I wonder if I have this, right? The first thing we do is go to the planner and say, can you just go do a quick site visit and give us sort of a ballpark sense, right? Before we dive too deep in this process, does this sort of pass the smell test, right? So A, now B, D are certainly ones that we see a lot fairly often. If you are in a UEZ, an urban enterprise zone, just to note that your powers are limited to tax exemptions to pilots, essentially, which we'll talk about later. So they're all the other powers that we're going to talk about that spring from redevelopment. If you solely meet criteria G, you actually don't get all of those other powers. You only get the power to do a tax exemption.
Okay, thanks.
Yep. And then in addition to those enumerated ones, we also have what we call Section 3, which is a piece of property that in and of itself might not meet any of those criteria, but is essentially necessary for the redevelopment of the parcels that do meet a criteria. So you may have 4 parcels in a row, 3 of which meet a criteria, 1 doesn't, but the last one is needed, whether it's to round off a corner, to get site access, because of setbacks or floodway issues. So there are ways to bring in property that in and of itself don't meet one of the criteria, aren't environmentally contaminated, for example, but that are effectively necessary to remediate the entire area. And so we do see that used fairly frequently as well. There's areas in need of redevelopment, and there are areas in need of rehabilitation. The key difference between those two is in areas in need of redevelopment, you have all the powers of redevelopment, including condemnation or eminent domain and long-term pilots, up to 30-year pilots. In areas in need of rehabilitation, you have all of the powers of redevelopment except for eminent domain and 30-year long-term pilots. So you're still going to do a redevelopment plan. You can still negotiate with a developer, select a developer directly without going through an RFP process if you don't want to. You can contribute land, you can do all these different things. You can change your zoning, et cetera, but you can't condemn property or grant long-term pilots in areas in need of rehab. That said, an area in need of rehab designation is a lot easier. And the ones that we see in New Jersey most often are the second bullet, more than half of the housing stock is at least 50 years old, which we have a lot of here in New Jersey. And the last bullet, where a majority of the water and sewer infrastructure in the area is more than 50 years old, because we have a lot of very old infrastructure here in New Jersey, right? We still have clay pipe lines here in New Jersey. So those two primarily are the ones that that we see and allow municipalities an easier path forward, perhaps, to make a redevelopment project happen where they can't otherwise meet one of the more stringent criteria for an area in need of redevelopment that we went through a minute ago. In either event, once we have our redevelopment area, that was step one. Step two is adoption of a redevelopment plan. This redevelopment plan is effectively the zoning for the area, right? It is what is going to control what can or can't be built, what are permitted uses, what are prohibited uses, height, density, bulk, setbacks, parking. All of those things are going to be included and determined by the redevelopment plan. That plan, once again, is controlled by the municipal governing body. The whole process at the end of the day is controlled by the municipal governing body. So the municipality creates the plan. They can either do it themselves or they can direct the planning board to do it. In my experience, that largely goes back to the question of which planner is sort of driving the bus in the transaction in total. If it's the planning board's planner and they have experience in redevelopment projects, then they are probably the ones that are going to produce and prepare the redevelopment plan. My experience, more times than not, it's a municipal redevelopment planner that's been hired for the project or for all of the projects that the municipality is undertaking that will both study the area and will create the draft of the redevelopment plan. Either way, that plan starts at the municipality. It gets referred to the planning board. The planning board gets to review it. They get to determine whether or not it's consistent with the master plan. It doesn't have to be consistent with the master plan, which is okay. It's okay if it doesn't. You just have to know where it's not. Generally, typically, it is consistent with the master plan, however. And the planning board can make recommendations. They can suggest changes. We have a list of prohibited uses of the retail in our center of downtown project, but we see one of the prohibited uses that's not listed is a tattoo parlor. We would like that to be listed. That's a recommendation comes from the planning board. Whatever the recommendations are, when ultimately those recommendations go back to the municipal governing body, that municipal council has the ability to either accept or reject one or all of the recommendations of the planning board. So they truly are recommendations because the municipality can say, we appreciate those, we've thought through those issues, and we're going to reject those recommendations, and they have to state on the record why. And then there's an enhanced vote, a majority of the full governing body, to confirm that they don't want to take the recommendations of the planning board. Generally speaking, practically speaking, we often see either no recommendations or one or two recommendations that are likely accepted, right? Good ideas that the municipality and the planner hadn't fully focused on, And so those things end up getting included into the redevelopment plan. That plan is ultimately adopted by ordinance of the municipality. So similar to the redevelopment area designation, starts at the municipality, goes to the planning board, comes back to the municipality, who ultimately makes the final decisions. The plan has a host of statutory requirements. I don't really want to go through all of these, other than, again, you are going to look at the master plans of any of your neighboring municipalities. You're going to look to the county and the state master plan. And more recently, your redevelopment plan is going to include plans regarding EV charging stations, right? So that's somewhat of a newer add, that these projects now can include EV charging stations, and they get bonus credits for parking if they do. The redevelopment entity is the entity that sort of controls the process, that is negotiating with a developer, entering into a redevelopment agreement, enforcing the redevelopment agreement. 99 times out of 100 in a municipal project, the municipality itself is the redevelopment entity. But there is a separate designation of who the redevelopment entity is under the law, which is why we have to select that. But just to point out, some municipalities, perhaps larger or more urban municipalities, have redevelopment agencies. Jersey City, Bayonne, South Amboy all come to mind. Parking authorities can be redevelopment agencies. Improvement authorities certainly can be redevelopment agencies. If anybody's been to a soccer game at the Red Bulls Stadium in Harrison, that was a project that we did through the Hudson County Improvement Authority as redevelopment entity. And housing authorities can be redevelopment entities as well. Probably the biggest project I can think of, and it was mentioned earlier in the intro, is the Newark Housing Authority was actually the redevelopment entity in charge of developing the Prudential Center in Newark. And of course, we have the redeveloper. Oftentimes, the redeveloper already owns the parcel of property or parcels of property, or they're the contract purchaser, right? They're acquiring contract interest in the property, and then as soon as we get through this whole redevelopment process, they close on their properties and they move forward. If you have property that's 100% in municipal control, we often see requests for proposals. Those can be, they are not driven by the local public contracts law. So you have some flexibility in how you do that. What we often see, if we know what we want built on the site, is the property owner, the municipality sending out an RFP saying, we want a project built, here's the redevelopment plan, provide us, your proposal for what you would build, how much you would pay for the property, what a pilot might look like. And then you can ultimately sort through, you can negotiate, you don't have to pick the one who provides the highest price, et cetera. There are some circumstances where we don't know what we want to do with the property. And then it becomes more of a request for expressions of interest. So here we have a parcel of property, here's where it's located, here's everything we know about it. Development community, you tell us what you would do with the property, what you would build there, what you would pay us for it, right? What an income stream to the municipality might look like. So it doesn't have to be 100% buttoned up. There are a variety of ways that you can go out and try and solicit the development community, depending on the circumstance. We often do conditional designations, namely, and hopefully the CFOs will appreciate this, because as soon as we do a conditional designation, we can fund an escrow. The developer can fund an escrow more specifically, and start paying for all of the municipal professionals' costs incurred in connection with this project, including the prior work, the work that was done to study the area, which again is largely a planner role, and the creation of the redevelopment plan, also largely a planner role, both with some legal involved. All of those costs can be reimbursed from the developer escrow. So we like to get that conditional redeveloper designation done as quickly as possible, so that from that point forward, we are, the costs are being directly covered by the developer.
And do you right up front say we have approximately $80,000 worth of expenses that are going to be part of that they know ahead of time that they're bidding on that, or do you not do that?
So Jim, in a bid circumstance or in a proposal or procurement circumstance, whether, no matter how we do it in the ways I just described, we will typically say, we'll insist obviously in there that they're going to fund an escrow. Again, all of the developers know this. This is just the cost of doing business in New Jersey. And we will also indicate that they should be prepared to reimburse the municipality for, X amount of costs, which is often just a range. I mean, we don't necessarily get it to the dollar because we don't know how long it may take to get from that moment where we're issuing an RFP to the moment where we're actually signing that conditional redeveloper designation. So we often overestimate, but we do give them a ballpark sense so that they understand, what they're coming in with.
Got it.
Types of redevelopment projects, they sort of run the gamut, right? Mixed use. In Wharton, I've heard John Reinhardt's name a lot today. Right on Main Street, we've got a block-long residential over retail project, which is residential on the bottom floor. I'm sorry, retail on the bottom floor, apartment, multifamily rental on the top floors. And on the back side of the building, it's actually basically townhouses with a shared parking lot in the middle. Fairly common project. Commercial projects can be everything from high-rise residential buildings in Jersey City to, Newton, where we did a 100,000 square foot corporate headquarters and research facility for Thor Labs. Age-restricted projects down in Plumstead, we've done over 55 for sale condos. And in Berkeley Heights and a lot of other places, we've done over 55 rental apartments, for example. Infrastructure is interesting, right? Asbury was mentioned earlier. The key challenge to changing Asbury's waterfront was actually the infrastructure needs to support the development. So a lot of the redevelopment process, the redevelopment area bonds, the financing that was done was all really in support of public infrastructure that needed to be built in order to then support all of those development buildings, the residential, the hotel, and everything that you sort of didn't see 10 years ago that you see now. Public projects are the other sort of one I wanted to highlight. Berkeley Heights, we did a municipal complex. That was a project that is on public land, owned by the public entity, operated, paid for by the public entity through municipal bonds. But the property did meet a criteria as an area needed redevelopment. It allowed us at the time to procure a redeveloper who was really a contractor, if you will, via an RFP, RFQ process. It wasn't lowest responsible bidder, which was important for a project of its complexity and size, particularly when you have police and jails and all of the security issues that go along with that. And in Ridgewood, we did a parking deck similarly, public land, public parking deck, financed by bonds, property met criteria as an area needed redevelopment, did a redevelopment plan that called for the construction of a parking deck, and again, went through an RFQ, RFP process to qualify a certain number of bidders that we were comfortable with from a experience and skill perspective, and then within that group, go out and get a price. Those processes worked really well, but for those of you that are familiar with the Bergen County courthouse case, referred to as Dobco, the state Supreme Court ultimately has said that when you have a public project on public land with public funds, you can't use the redevelopment law to procure that developer. They basically view it as a workaround of the local public contracts law. Not that you can't use redevelopment for the project, but the procurement can't be done the way you would normally do a procurement under the redevelopment law. So it's sort of an evolving space right now because the court said you can't do it for that specific project. You can clearly do something with a private redeveloper who's privately investing and privately taking the risk and the rewards of the project, and everything in between is sort of unspoken for. But if you are involved in a project like that, you should note there is a new design bid build law that allows you to effectively go through that RFQ, RFP process that I described under that law and effectively get you to the same place. So redevelopment combined with the design bid build law might be a way to get you to sort of the same place that these projects, how these projects got done.
Hey, Matt,
So-
before you
yeah.
move on, I'm just going to launch the first poll.
Oh, sure.
So it kind of applies to what you just went over. So has your municipality undertaken a redevelopment project? I'll leave it open for a moment and then share the results.
Matt, how we doing on timing with the number of slides and everything?
Yeah, I'm gonna skip through a bunch of stuff here, Jim, for sure. Because we're at 12:40, right?
Yeah, and I think they want time for Q&A and all.
Yep, yeah, okay, yep, good.
That's correct. 12:40.
We are not keeping everybody on their Friday, a minute past 12:40, so.
Thank you.
All right, so half the group's familiar with this, which is fantastic. Katie, I assume we make this slide deck available ultimately to everybody, right? So they can
Yes,
ultimately
I'll
see
send
it.
it.
So I'm going to skip through a bunch of slides and try and get to some of the financing elements of this, but you have a redevelopment, you have a redeveloper, you're going to enter into a redevelopment agreement. There we go. It's going to be the contract between you, the municipality, and the redeveloper. There are title restrictions, covenants you have to include. This is a laundry list of the types of things that are going to be included in your redevelopment agreement, including construction timetables being a critical one. And then once you have your redevelopment agreement, you're launching into a financial agreement if that's what's going to happen. The developer's got to go get all of their normal governmental approvals, state, DEP, DOT, local, et cetera, and then go get the project constructed. So we've got a project. What can we do to help the project from a financial perspective? We see this more and more. The 50% of you that have done a project, I think the next question I'll be curious in about how many of you are involved in the financing side. So there's a handful of choices. What we see most are long-term property tax exemptions. Of the laundry list here of things that a municipality can do, long-term tax exemptions or pilots and bonds are the two that are most popular. The loans or grants, you can make them. We see loans in the structured sense, but usually it's in connection with a bond issue. Again, we've got 3 different types of tax exemptions and abatements that we can use. The most common is the long-term tax exemption law, available in redevelopment projects, areas in need of redevelopment. 5-year exemption abatement law, again, is only available in both, but you can't do long-term tax exemptions in an area in need of rehab. And then HMFA, not likely to be one that anyone here is going to be focused on. So the long-term tax exemption, which is the pilot, couple key things, right? But for the annual service charge, but for the pilot, the project would not be built, right? That's a critical threshold. I'll go through a math example of how we prove that out. But what happens is the developer provides a pro forma. It's got construction costs, operating expenses, and rent assumptions. And of course, the construction costs are really high. The operating expenses are really high, and the rent numbers are low because that's what shows the most stressed pro forma and shows a need for a pilot. So what's really important for the municipality to undertake, whether it's in-house or through, an outside consultant, is somebody who's very comfortable and familiar with the redevelopment space to come in and scrub the developer's pro forma and say, your project costs are too high because we've seen this exact project built 27 other times in our work. And instead of $300 a square foot, it's going to cost you $200 a square foot. Your operating expenses are too high for the same reasons. And your rent levels are too low because there's a project around the corner that is getting rents 20% higher. And when your consultant or you ultimately right-size that pro forma, now you can look and say, what is the shortfall? And does the project still need a pilot when we're sort of agreeing on what financials are going to look like? And if so, what's the appropriate level of that pilot, which is important. Pilots are usually 10% or more. They have to be 10% or more of annual gross revenue. Developers always start with 10% of annual gross revenue. Some projects need that, but oftentimes projects can afford more or can afford more over time. And the scrubbing of that pro forma through, again, either in-house or an independent municipal advisor is really important to make sure that we, the municipality, are getting the best deal possible. This is the process to get you from an application for a pilot through to project completion. Again, the pilot is at least 10% of annual gross revenue. It can also be a percentage of total project cost. You don't see that very often, maybe in hotel deals where operating expenses are really high. And because annual gross revenue is just that, it ignores your operating expenses. It is just what are your revenues that come in, and we get 10% of all of those or more, whatever the percentage is, regardless of what the regardless of what your operating expenses are. So while we're concerned about that from a financial viability perspective, it doesn't impact our pilot amount. On a residential project, you're going to get rents, you may get parking fees, you may get pet fees, you may get storage fees. All of those things are included without any deduction. And whatever our pilot number is, 12% of annual gross revenue, that's what we get. There is required stages where you say, the pilot becomes the greater of, let's say, 12% of annual gross revenue or 20% of otherwise applicable taxes for a certain number of years. Then it goes 40%, 60%, and 80%. Typically, the percentage of annual gross revenue will be higher than at least 20, 40, and likely 60% of otherwise applicable taxes. Maybe around the 80% number, you might see that number overtaking the AGR number, but it's usually at the back end of the 30 years. It's usually not upfront at all. 95% of the pilot goes to municipality, 5% goes to the county. As I think Jason mentioned earlier, nothing goes to the school or any of the other taxing districts in this case. And we can have probably a whole separate forum on how and why the schools are not harmed by that. But it is a conversation that you need to have depending on what type of project it is, depending on whether it's a project that has an impact to the school or not. Warehouse doesn't, right? Residential might, over 55 might have it much less. What does the enrollment at the school look like? In most suburban entities, it's declining significantly. So we have a project that's going to produce 16 school kids, but we're losing 100 kids a year for each of the last 5 years. So what is the impact, right? All of those things are discussions you're going to want to have. But at the end of the day, as I think all the CFOs know, when the Board of Ed strikes their budget and says, I need $30 million, they get all $30 million, regardless of whether a project is piloted. The pilot is typically for 30 years. It can't be longer from project completion. That's where the 30 years starts. Or 35 years from when the agreement was executed. Most projects don't have longer than a 5-year construction period, so you're typically collecting the full 30 years of pilots. If you have a big multi-phase project, then you actually have 50 years before the term expires. So still 30 years for each exemption, but building 1 is 30 years starting now. Building 2 doesn't get built for 4 or 5 years. You still have room to run all 30 years and stay within your 50-year window. Financial agreement is going to govern all of the terms of your pilot. What the pilot is, that your 5% goes to the county, that if it is a commercial project, there's a land tax credit. So in a residential project, typically, the land tax portion of the project will be exempt so that you're not providing the land tax credit. If we have a project where we can't do that, the developer is going to make a pilot of X. They're also making land tax payments, and they get to credit the amount of their land tax payment against their pilot. Well, the injustice there is the municipality is losing dollars that it gets 95 cents of in exchange for dollars that it's only getting 20, 22, 25 cents of, right, at the local level. So where possible, since it's the math is irrelevant to the developer, they're paying the same thing no matter what, we try to exempt the property from paying land taxes so that we don't have the land tax credit eliminate pilot dollars to the municipality where we're getting 95 cents. There are also a variety of tax credits that, depending on the circumstance, can be used to fund projects. And then we have financing options. I heard in the last presentation, a great discussion about bonds. We're going to talk about a couple different types of bonds here. The first are general obligation bonds, the ones that we're probably as municipal finance officers all familiar with issuing. We issue them for roads, sewers, parks. We can issue them in connection with a redevelopment project as well, including a project that the municipality is undertaking, right? So if we are doing water and sewer infrastructure improvements in connection with a redevelopment project, the municipality, as the redevelopment entity, can issue bonds and finance effectively its own project. Or maybe it's financing a bigger component of the project, which is okay too. The reason it's important to sort of have this distinction is because under the redevelopment law, that bond ordinance doesn't require a 5% down payment. Our project description is very, very general. Aid in connection with the redevelopment project pursuant to the redevelopment plan. And we're not bound to our local bond law useful life limitations. So our financing can be anywhere from 2 to 40 years, effectively notwithstanding what we are producing, what we are financing. So there's some flexibility and some cost relief provided to the municipality if we're doing a bond ordinance under the redevelopment law, as opposed to doing a bond ordinance under the local bond law, even though we arguably could finance the same improvements under either one. Those bonds are secured by our typical ad valorem GO pledge, and they're adopted by bond ordinance, not otherwise unlike a regular bond ordinance. We also can do revenue-backed bonds, bonds that are basically secured solely by the revenues from the project. We don't see that very often because revenues may not be secure. You know, it's a much higher risk for the bondholder, which means the interest rate is much higher, which means the pro forma gets complicated. There's more stress on it. So we generally don't see revenue-backed bonds issued very often, but they are authorized under the redevelopment law. And again, in that case, you're probably issuing them as a conduit, right? Perhaps without the GO pledge behind it. And then last, redevelopment area bonds, which allow us to pledge the pilots that we've granted under the financial agreement, or special assessments, which we can do in redevelopment for effectively any portion of the redevelopment project. Many of you are probably familiar with special assessments for sidewalks or for new water or sewer infrastructure and other types of improvements. These special assessments work the same way, just for a broader category of improvements, and those can be pledged directly to pay bondholders. So in the event that the developer fails to pay its pilot or fails to pay its special assessment, the municipality, as the conduit issuer of those bonds, has no obligation to make a payment because you haven't received any money. And the developer can only look to the lien of the pilot or the special assessment, those tax liens, to recoup whatever money it's owed under the bonds. Now, not to confuse matters, but we can also turn around and guarantee, ad valorem guarantee those bonds if the municipality wanted to lower the interest rate, because bondholders love our municipal GO credits, which are obviously more secure than this pilot or special assessment credit. Or we can do a hybrid where we issue GO bonds and we know we're going to get the pilot revenue and use that pilot revenue in our budget to pay debt service on that specific set of bonds. In that way, that example is not unlike a utility, right? We run water utilities, sewer utilities, parking utilities. We take those parking revenues and we hope they're sufficient to pay debt service on bonds. But at the end of the day, those bonds are secured by the pledge of our ad valorem taxing powers. Many municipalities have chosen that method of financing. It's simpler, it's the cheapest form of capital, it gets you the least expensive debt. And in those circumstances, often the municipality is keeping whatever the difference is between debt service and the pilot. So the pilot is more than enough to pay debt service, but the more in debt service we have to pay, the less in residual pilot there is that's left over. So the municipality becomes incentivized to find the cheapest source of capital so that it keeps more of the pilot dollars. And then lastly, I just wanted to take you through a project from a little bit of a pro forma perspective. This one actually is evaluated slightly differently than the way I described earlier. So it gives us a good sort of sense of how a municipal advisor or you all might look at this project. So we have a residential project. We know what we're going to get in annual rents, $4.2 million. We know what our operating expenses are. We get to a net income number. Using a cap rate into that net income number, we have a market value for our project of $45 million. And again, those rent numbers and those operating expenses have been vetted and sort of cross-checked by our either in-house or professional. On the other side of the table, we have our construction costs, which have also been vetted and confirmed by our third party. So what this table is showing us is that we have a project that's going to cost $56.5 million to build. And immediately upon completion, it's going to be worth $45 million. So there really isn't a developer who is going to invest their money in a project that has that upside down valuation, nor are you going to find a construction lender. These deals are typically about 70% plus or minus construction loan, 30% equity. We're not going to find a construction lender who's going to lend under that circumstance either. So effectively, but for tax relief, this project is not going to get built. So if we start to look at what that tax relief looks like, trying to get the developer to that same 5.7% return on their equity that they're looking for, they can afford to pay about $330,000 in taxes, as opposed to what would have been about $900,000, by the way, in taxes on this project. So that's effectively where you want the pilot to be, so that the project can work and ultimately the municipality can collect the revenue that I'll describe in a minute. In this particular case, to get them to that $330,000, it was less than 10% of annual gross revenue. And again, our pilot can't be less than 10% of annual gross revenue unless we issue a wrap bond, which we did not do in this case. So the developer in this case effectively agreed to pay the bare minimum, which we now knew as a municipality was the bare minimum. I mean, they really should have been paying less, and effectively just do the deal on a slightly lesser rate of return than what we would consider acceptable in the market, right? But the deal still got financed. This deal is actually under construction. So they ultimately have made it work. This shows you sort of the power of the pilot, right? Conventional taxes, first of all, that's the number the developer couldn't pay. So while it shows you what the municipal would get, the reality is they would get zero or whatever they're getting today on the property. But with a pilot at the 10% of annual gross revenue, the township is collecting $400,000 a year. So again, this is always a weird one to show, and I did it last night. We do it all the time with municipalities because you're showing what the municipality will collect, $400,000, against what it could have collected if the project could have been conventionally taxed, which it can't, which is about $171,000. So you have a significant increase over what this project otherwise would have received if it were conventionally taxed and somehow built, which we've already sort of proven it won't. This deal is a 30-year annual service charge. Each deal has a minimum annual service charge, basically the amount of taxes paid in the prior year. We exempted the land and improvements. And for all of your troubles in administering a pilot, the bill, the collection, going through the developer's audit to confirm the amounts are correct, you are allowed to charge an administrative fee up to 2% statutorily. In this case, the municipality agreed to a fee of 1.5%, but you can get a fee of 2% of the annual service charge. And
just to interrupt, there was one I'm sorry, you are at the end there. Bill Homer's coming in here saying, according to Keith Bonci, attorney for the TCTA and DLGS tax specialist, unpaid pilots cannot be placed on tax sale. I
mean, we've seen them sold. So I'm not sure how to respond to that. Yeah, they are a tax lien like any other lien. They are subject to tax sale. What we often see typically is that the construction lender or the long-term lender will step in and make those payments. We constructed a multi-million dollar warehouse that sat vacant, literally vacant, 1.4 million square feet, sat vacant for 5 years. And every pilot payment was made on time by the construction lender or the long-term lender, because as soon as that tax lien is generated, as you all know, right, that lien trumps the lender's construction mortgage or long-term mortgage. And all of a sudden the lender is, basically losing control of the property. So what we typically see through self-enforcement is that the liens get paid, and they get paid by the lenders who don't want to lose out on the property over what is generally a small amount of money.
Thank you.
I'm going to do another polling question before we move on here too. This one is, has your municipality considered or granted a long-term tax exemption or pilot? All right, everyone make sure you answer, and I'll share the results in a minute.
Jim, while we're going through this, just as a housekeeping item, are you pulling up your slides, or do you want me to pull up your slides for you?
Jim, I think you're muted.
Maybe I'm doing Jim's part too.
Nope. The I couldn't hear what you said. I don't know but the audio conked out on you, but I'm going to start my PowerPoint slide.
Okay, good. That was it.
Close out, messed up on that. See if I can show all windows. Okay, it's not doing what I want it to do, so bear with me here. There we go. Gonna wake everybody up with a joke after we just saw the results there. Hey, Matt, what's the difference between Dubai and Abu Dhabi?
Oh, I'm terrible at these. I don't know.
You know? Well, the people in Dubai don't like the Flintstones, but the people in Abu Dhabi do. So anyway, trying to wake everybody up here. Just got a few minutes. We're going to go through this quickly. So our deal, it was Surplus Elementary School, so it's public property. We partnered with the BOE. We wanted to help them sell it for the most amount of money possible. Redevelopment gave us insurances on what would be built and on the revenue stream that we would get. Working with the two boards was brutal. Once the legal steps were completed, we went through an RFP, which Matt talked about, to select the developer. We selected KRE out of Bridgewater for 100 rental apartments and some commercial. And we selected Mark Built Homes for 35 condominiums. It took a year for the legal process, 2.5 years for the selection process, and then it took a couple years for the construction. So these things don't happen fast. Here's an image of the property, this little Google screenshot. There's some other images as well of the actual property. So Matt talked about the fact that you could put terms in there and really kind of control the development, right? That's one of the benefits. 135 units on 5 acres. We gave them very specific information on design, massing, setbacks, the infrastructure. They had to pay for improvements for water and sewer. They had to give us a public amenity. That was part of the RFP process. They gave us a 3,500 square foot community arts center for $1 for 30 years. If you're in this situation, you're selling public land or even not selling public land, if it's an RFP and you're giving them that benefit of having the assurance of development and the pilot, you could get preserved land, additional parking, additional affordable housing. Other terms, you could include a LEED green building certification or other green building certification. You can detail construction hours in the redeveloper agreement. You can say, hey, you're not going to get reimbursed for garbage like a normal apartment would. Your road is private and alike. We did this when affordable housing was extremely murky before Fair Share Housing Center took everybody to court. We got a $2.1 million payment to our Affordable Housing Trust Fund, and the development was not inclusionary. We wouldn't do that now. We would do an inclusionary development. But you can require more than the inclusionary amount if you wanted to. If you wanted to say you're going to do this development, but you're going to put 25% affordable housing in it, you can certainly do that if the numbers make sense. One thing that was big for us as we were doing this was we wanted this project to get going. We didn't want them to land bank. Was there were criteria in the redeveloper agreement that said you have to have this done by blank. You have to have this done by blank, or we're going to pull your designation as a redeveloper. That's important because some people will just take it, land bank it, and you think you got a deal, and all of a sudden it takes 5 or 6 years before they even put a shovel in the ground. Here's a picture of the art center that we got. It's the bottom left corner. They gave us an outdoor stage. They gave us the indoor space as well. So it's a great public amenity that we were able to negotiate for free. So in pilot, in terms of the information, it's a good deal, but it hurts. Chrissy's in my brain. Chrissy's listening right now, dealing with all of this, constantly referring to all the documents. And probably just a little picture there, but these are all the documents. If you can see the little picture that I'm in, and we're constantly like, okay, section 302B, etc. So we actually, like I did here, on page 10 of the redeveloper agreement, it says we got a $30,000 administration fee. On page 16, once the project was up and complete, we get that administrative fee that Matt was talking about. We just fixed it at $14,000. We suggest, I don't know if this is legal, Matt could tell you, Matt, can you have a penalty if the audit is late? Because you're obviously predicating future payments of the pilot on the audit. Can you have it? Can you have a penalty there, or how do you deal with that? Have you ever had a situation like that?
Yeah, that's a good point, right? I mean, it's statutory. The timeline is statutory, so they're violating statute. I mean, you could certainly enforce via court order.
But nobody wants to go to court. I just want to say
exactly right.
You're going to get
we have not negotiated.
Penalty.
I've not seen a financial agreement that negotiated a late penalty for that. But you're right. I mean, you're reconciling, and you're always reconciling, going backwards and figuring out what the credit is going forwards based on that audit. So it is important that it comes in relatively timely.
Okay. So as Matt said, make sure all the revenues are considered. In our situation, they actually have one water meter, and then they turn around and sell water to their residents and sub-meter it. So we want that. We want parking. We want the health facility fees and alike. So you want to make sure you collect all of that. Matt touched upon the concerns that residents will have. Are they getting a deal? His slide showed where, hey, if it was ad valorem tax, it was $800,000. They're only going to pay $400,000. Why are they getting a deal? Why am I not getting a deal? Builder B or Builder C might complain, or just a resident might complain. So it's really important to have a public process. Everything we did was public. We had a web page, and we even go to the extent of, and here's some of the press that we were putting out. We even go to the extent of every year in our budget presentation, we show where this lands in terms of the 6 largest property taxpayers the prior year. So we can sit here and say, hey, we gave them a deal. In our particular situation, it was 12% gross shelter rent. They didn't get any deals. That we are allowing them to credit their land tax, but so this $1 million includes land tax. We actually said, hey, it's not all pilot. They're paying some land tax. So it's not like they're only getting this pilot as a deal. They're paying regular ad valorem tax like everyone else. But we're able to show, compared to, these are all corporate office buildings, we're able to show that, hey, this is the number 3 largest, highest property taxpayer. We were saying that right from the beginning. If our projections are right, this is going to be a top 3 or 4 payer of property taxes. We use that in quotes because we're getting the pilot. I just want to show to you that because it was a high-end developer and a high-end apartment building compared to some older stock that we have here, the amount of property tax or pilot and land tax that we're collecting based on the number of units, this is just for the residential component, is much higher. So if anybody comes in and complains, we can turn around and say, hey, they're paying more than General Wayne or Rosedale Manor or any of the other apartment buildings. So this is a good deal for us as well as a good deal for them. Another joke. Hey, Matt, did you hear about the new Japanese sushi restaurant that opened in Madison that caters to lawyers?
Is it called sashimi?
No, so sue me.
Ah,
Good, you almost got it.
almost.
Anyway, so it's so difficult to manage all of this that we created a little internal manual. KRE annual reports. Here's where it says they have to be generated by section 7.02, section 7.03. The pilot calculation, as Matt said, maximum, it's section 301B on page 10, and it states that KRE shall pay no more than ad valorem taxes with an assessed value of $24,000, top end $475. But the minimum, and that's not correct, the minimum KRE apartment portion pays a minimum base service charge. The condos, because we unfortunately have condos there as well, and I would not do that. I'll explain that in a little bit. The minimum base service charge increases, but the actual amount they pay is the greater of base service charge, 12% of annual gross shelter rent, but it can't be more than 100% of the ad valorem taxes. So here is the actual screenshot from this year's the audit that they sent. One thing that I think I might negotiate in next time, Matt, is required more detail, because they just have rental income and other income. And I might, if I knew what the other income was broken out between water, between parking, well, actually parking is separated. If I knew a little more detail on this, I might feel a little more comfortable. But anyway, we basically take that 4.3 million for this upcoming, or 4.2 million for this upcoming year and calculate it. I think next I have, so this is, so we made it like a legal sized bill. So I cut it in half here. And this is last year's, this shows some information before the audit had come in. So if you look, and does my mouse show up on here? It doesn't, but in the second column under where it says Chrissy Mahler tax collector, our excellent tax collector, it shows the base service charge. It shows the 2021 annual gross revenue as reported in their audit, 12%. And then it goes through the calculation of subtracting out the land tax credit, a true up from the prior year, because as Matt said, it's kind of playing a catch up. And then the net pilot charge, they've already paid for 2 quarters, because we're kind of doing it, we're just here, we're doing it like we do regular land taxes. We're billing them at the same time. They're getting a little coupon. They're doing all that stuff. And so they already prepaid 2 quarters at last year's rate. So just like your regular taxes here kind of, get adjusted for the 3rd and 4th quarter payment. That's what happens here. And they actually, I don't know if they cut out this little stub, but it kind of makes us happy because so Matt touched on it briefly, but in our situation, if you look at total what they pay, quote unquote, since we're not giving them, because the revenues of the apartments in Madison and the apartments they built are so good, and we knew that was going to be the case given the density that we allowed, 135 units on 5 acres. We knew that it was going to be very close to ad valorem taxes, and you can see the difference of what we get at the very bottom versus what we get with and without the pilot. So, and that is with Gulp giving the Board of Education 32.5% of the pilot. I don't want Matt to have a stroke or any of the CFOs to have a stroke on that, but we did that because this was Board of Ed property. And so we were trying to sell the property to get them the most amount of revenue, which is why we allowed this density, which is why we allowed the pilot payment. It gave the developer assurance of what they could build. It gave the developer assurances of what their payment would be. And in a, whether you want to call it a weak moment or a moment of kumbaya between the Board of Ed and the Borough of Madison, we did give them some money. Don't tell your governing body that, or they may be expecting you to give to the Board of Education. So this is, I think, my last slide. I tried to do this very quickly, but there's an audit note in there. As a reminder, this is outside the cap revenue. One of the best parts about this, right? We talked about it with Karen, how maybe you could dedicate it towards capital or towards funding another project. Remember, the county gets 5%. Morris County doesn't really send us a bill, so we have to remember to do it. and then you end up with this note in your audit. And with that, I want to give a shout out to my audit team, Val, Caitlin Janucci-Orton, and Courtney Renfro from Nisivoccia. They're the best. I don't want them to ever change. I want those guys for at least the next 5 years. And special thanks to them, and special thanks to Jason, Joe, and Bill Homa, who are at least were on this call and were all my teachers when I went through my certification process. And I'll end with one more joke. Bono and the Edge walk into a bar and the bartender says, "Oh no, not you two again." Come
Love
on.
it.
But
Well
you
done.
said you were
Love
gonna,
it, Jim.
but you said you were gonna take your speaker microphone, click your microphone, give me a chuckle. Come on.
Love it. Nothing better than giving us a few dad jokes for Father's Day weekend.
Come on.
Mhm.
Come on, how do I get out of this screen sharing? Stop screen sharing.
We do have just a couple of questions that did pop up for the presentation there. I'll go through them here with you. After the pilot expires, is there a probability that that there will be a reduction in the cash payment to the town?
It's a great question. It's a near certainty, right? Because what's going to happen is for 30 years, you're going to collect 95 cents of every pilot dollar. And then in year 31, the property is going to be conventionally taxed. So even though because of that 20, 40, 60, 80 ramp up I talked about earlier, the payment the amount of the payment being made by the developer may not change much, because at best it's going to go from 80% of otherwise applicable taxes up to 100% of otherwise applicable taxes the first year that the pilot expires. But what's also going to happen is that's a conventional tax. So you're going back to getting 20 some cents, I'm guessing, depending on municipality, of that tax dollar, and no longer getting 95 cents on the tax dollar. So that is certainly something for maybe the younger CFOs to think about. I mean, for some of us, we're not as worried about it, but that is a reality, right? That all of that money that Jim just showed in that slide, that's going to change. And the municipality, depending on how many pilots and what your budget circumstance is, you are going to want to think about that as you get closer to the pilot burning off. It's a great question.
And Matt, we put in one of our towns, we put in a note into the file, the permanent file, that halfway through the plan, that we were going to start weaning the town off of that revenue as a revenue towards their budget.
Yeah, which is smart and interesting, right? Because you would also expect that revenue is going up and up and up, right? For a variety of reasons. One, rent numbers are probably going up, which means gross revenue is going up. Two, a lot of pilots might be 10% of annual gross revenue for the first 10 years, 11 or 12% for the next 10 years, and 13 or 14% for the next 10 years. So you might have an increase in pilot revenue just from the actual, the financial agreement negotiated terms, or because the 60 or 80% thresholds kick off more pilots. So it's ironic that as the amount of revenue increases, you have to sit there and try and wean them off a bigger number every year than the year before, most likely.
So I see Bill Homa's comment, and God bless Bill Homa. 460 pilot units billed individually. That's one of the reasons why the condo situation is not great for us. It's 35 individual bills that we have to send out. The calculation for a pilot on a condo, at least in our financial agreement, is different because there's not rent involved. And so it could get a little bumpy and a little murky. If someone owned the condo for a long period of time, it's based on the purchase price. And if they owned it for 20 years, someone could say they're living in a condo that's worth $1.5 million and my house is worth $1.5 million. They're paying $20,000. I'm paying $35,000 a year. You're giving them a deal. So that, at least in the way our financial agreement was structured, is not desirable. And what Bill's talking about here, sending out 460 individual bills, is not desirable. So it's this large apartment complex, one audit, one bill, that makes things a little easier, in my opinion.
Yeah, so we have, I think I mentioned earlier, an over 55 condo community in Plumstead Township down in Monmouth County. That's 440 units, about half of which have been constructed. The other half are being constructed over time. But I think, again, it is a challenge. Now, in that case, we had a RAB. So instead of having to look to what is admittedly sort of a convoluted formula in the long-term tax exemption law, for, what is the 100% of the payment of the purchase money mortgage at the going rate when you bought the condo, which is sort of what Jim is alluding to. And I'll come back to that formula in a second. Because we had RABs, we basically set the pilot as a percentage of annual gross revenue, right? So we said in that case, I think it's 55% of annual gross revenue for a certain number of years. And then that ramps up to being 100% of annual gross revenue. I'm sorry, of otherwise applicable taxes. Let me start over. The pilot is equal to a percentage of otherwise applicable taxes for each condo owner. So in that case, it's probably a little bit easier to do the math, because the tax assessor certainly can assess each of the condos, can determine what the tax bill would have been, and then the municipality's tax office is just applying the percentage according to the financial agreement. It's 55% of otherwise applicable taxes in the first 5 years, and then it ramps up to 100% of otherwise applicable taxes at the end. So that's a method of doing it that maybe is a little easier from a computation perspective, but you're still sending out ultimately 440 individual tax bills with a pilot. The last thing I'll say is I was with a colleague last night coming out of a governing body meeting where we were having this conversation, and we sort of hashed out a plan to try and get that portion of the law changed, to change how you would compute an annual gross or a pilot for condos, because we see in multiple towns, Jim, what you mentioned and others, that the condo one is really too complicated. And we're just going to try and fix it. Quite frankly, we'll see how it goes. But
I just want to get in and do one last poll before we move on. This question is, does your town have any completed redevelopment projects? And if so, how many? There's a few options there: 1 to 3, 4 to 6, or more than 6. Share results. Thanks, guys.
And while people are doing that, I think with the way affordable housing is going in the state of New Jersey, and the desire to develop these what were office buildings and office properties, redevelopment is going to be helpful in that regard. It will also allow you to control the way the affordable housing is going a little more granularly than what's in your inclusionary ordinance. Maybe get some more out of it. Maybe you can get, maybe it's a 10-acre parcel, and you can have them densely develop 5 acres and then take 5 acres and preserve it in perpetuity. So you kind of can make the environmental folks happy that there's at least some aquifer recharge and some environmental benefits through a more dense development. And they'll always say, and I think they're right, these dense apartment developments typically don't generate kids into schools. So you don't have to worry so much about school census.
So Jim and Nat, what have you guys seen in redevelopments that you would never want to see again?
That condo payment.
Yeah, and
yeah.
as you know, the things Bill Homa just raised, we're absolutely dealing with that now. I mean, Plumstead has, all 100 and something residents showing up to the council meeting now because there, you've got, this is an over 55 community, but you're not eligible for senior freeze, right? You're not eligible for veterans. I mean, we've been trying to solve for that maybe legislatively too, especially in a circumstance. If you've got a pilot equal to 100% of otherwise applicable tax, I mean, it's an exemption, but it's not. So I realize that it's not technically a tax. The pilot's not, that's clear. And these programs are tax programs, but it feels to me like there should be a solution there that gets the math to be in the same place. So it's something we've got to work through for sure.
From an administrator standpoint, I think you just need to be as clear as possible in all the documentation, as clear as possible in what they can build, so they don't try to snooker you. In our situation, it was, albeit unique, that we're working with the Board of Education. We had pre-drafted the financial agreement. We had pre-drafted the entire redeveloper agreement. We said, you're bidding on this. If you want anything, one word on this change, you have to tell us what it is. So in the RFP process, we understood what the changes were going to be. We knew they weren't going to be minimal, because if you don't have all that stuff worked out ahead of time, all of a sudden, after you designate them, they have they have a lot more control and say and power, if you will. And then it becomes all of a sudden harder to negotiate things. So you want to get that stuff all buttoned up front. And if you have a good law firm like Matt's, I'm sure they'll do that.
Yeah, I think we're at our time.
Nicely done.
All right.
I just want to remind everyone there will be a survey when we end the webinar, so please complete that for credit, and we'll also send it out in the follow-up email with the recording and presentation materials from today. So with that, that's everything.
Great. Thanks, Matt, Jim, Joe, Katie. Appreciate
Thank
it.
you, everyone.
And you too,
Yeah,
John.
thank you all. This was fantastic.
you.
Appreciate it.
Take
A lot
care.
of fun.
Great. Thanks, everyone.
Yeah, thanks again for
care.
hosting.
Thank
Thank
you.
you.
Have a good rest of your day. Thanks, guys.
Bye all.
Take care.